we have on this edition of Small Cap Buzzer. Stay tuned to NDTV Profit.
केसरिया से मन जोगी हुआ रे दिल झूमे देखो मतवारा हुआ रे केसरिया से मन जोगी हुआ
हर पल मनाओ केसरी त्योहार विमल बोलो जुबान केसरी.
Hi, I'm Tamanna Inamdar. Watch me on NDTV Profit, where I break down the day's biggest business stories. What happened, why it matters, and what it means for your money.
Hi, I'm Neeraj Shah. Watch me on NDTV Profit for the most incisive market intelligence and meaningful corporate conversations.
And I'm Alex Matthew. Markets, mutual funds, insurance, personal finance. I help you cut through the noise and make smarter financial choices. And here's where you can watch us.
Presenting the all-knowing, all-powerful Tech Guru.
Whoa. Guru? I'm no guru.
Okay.
I'm just a guy who loves his tech.
A show where the mysteries of megabytes and motherboards shall be unraveled.
Bro, nobody talks like that anymore. This is all about connected ecosystems, EVs and AI that you can use in your daily life. That's what we do on Tech 360. Real talk, real reviews, tech that you can actually use.
Tech has changed. So should your tech show.
To understand the Tamil Nadu twist, join me in the midst of our people, language and politics. Vanakkam Tamil Nadu, here we come.
When others are warming up, I'm raring to go. The stories that matter, the stories that shape your life.
Hello and welcome to watching Prime 5 Nifty Vaishya Saigal. What's happening? How?
The show that sets the
Good afternoon, you're watching the afternoon edition of Ask Profit on NDTV Profit. A quick look at the markets. The Nifty has recovered nearly 300 points from the day's lowest point that we had seen at around 11:15 of close to 22,550, and currently we are trading close to 22,870 level. The only culprit or the biggest culprit when it comes to the benchmark index is Reliance Industries. That is pulling down the benchmark by more than 70 points, while all the other major other stocks have been gaining in trade. If you look at the sectoral indices, among the major sectoral indices is the Nifty Real Estate Index, which is up to around 1.7%, followed by the banking indices like the Financial Service, PSU Bank Index and the Private Bank Index, which are up anywhere between 1.5 to 1.6%. On the losing side, we have Nifty Energy, which is largely the oil and gas index, which is down or largely flat in trade, and this is largely because of Reliance Industries, which is down around 4% in trade. When it comes to the F&O names, it's Adani, Green and Trent, which are the top F&O gainers, up around 7%, followed by Kalyan Jewellers and RBL Bank, up anywhere between 5.5 to 6.5%. On the losing side, among the F&O stocks, apart from Reliance Industries, it's Astral, ONGC and Marico, which are down anywhere between 1.7 to 2.4% in trade. Well, that is broadly the markets. Let's also welcome in our fundamental guest on the show today, who will be addressing all the viewer queries today. Lancelot Dicona, CIO of ValueX Wealth, and CA Rudramurthy, BV, founder, director of Vachana Investments. Well, let's start off the first query coming in from Lalita from Bangalore. 100 shares of Dyani International bought at a price of 124.8. The current market price is 100, sitting on a big loss. She's asking what should she do? Should she continue to hold this counter, book loss or average? Lancelot, any view on Dyani International?
So, Dyani has been in this in the business of quick service restaurants in India, and however, that business has got impacted, and Dyani, if you look at its even last year performance, was impacted a bit, by the rise in input costs as well as the fall in demand, and we have seen that it has struggled, and that's where the stock has corrected. From a longer term perspective, I think the conditions are still going to be relatively difficult going forward. And hence, maybe there would be some further correction. If that happens, then probably it can be an opportunity to average out. But otherwise, at this point in time, one should probably stay away.
The next one is coming in from Sankalp. He wants to know whether the current levels are a good buying zone for Genus Power. Any view on this, Lancelot?
So Genus Power Infrastructure is actually as part of the Kailash Group, and it's basically into smart metering instruments and phase meters, 3-phase, etc. meters. If you look at the performance of the company, the growth has been relatively slow over the last couple of quarters, and I think the conditions being such that it's unlikely to pick up immediately. So one should wait, because this stock is trading at almost 14-15 times earnings. So one should just probably wait for either a price correction, or if there's an improvement in earnings, then one can look at getting into the stock.
Query is coming in from Suresh Nair from Hyderabad. He's holding 64 shares of Kalyan Jewellers, bought at a price of 502. Should he buy more, hold or sell? Rudramurthy, any view on Kalyan Jewellers?
Soumit, clearly today it has given a breakout above 405, and I'm very sure, seeing the current market price, the close will be above that breakout zone of 405. Looks very, very bullish, and also a lot of futures open interest addition is seen on the positive side. And also, if delivery volumes confirm that, this is a very clear breakout. Even at current market price, I will be a buyer and buy on dips to those levels of 405 where you have got the breakout. And I will be looking at initial targets of 445, 450 to come. Stock is available in futures. Definitely one can go long, and eventually even targets of around 500 is possible. So definite buy at current market price.
Okay. Sudhakar from Bangalore wants Lancelot, your view on Pine Labs. He has bought 40 shares right at the time of IPO. The share has been falling. Should he continue to hold this counter, Lancelot?
So, the IPO price was relatively very expensive. It was, while the business is good, they are in the business of payment systems, and that is helping, used all over as far as retail customers are concerned. But when you look at valuations, I think compared to the profits that the company is growing, the valuations are very high. So I think at this point of time, markets are discounting, all high value customers, high value investment options, and hence one should stay away from it at this point.
Okay. One of the viewers has bought few shares of TTK Prestige at a price of 582. Should he hold, sell or accumulate? Rudramurthy, any view on this?
See, the clear trend on TTK Prestige is downwards, and yes, I understand it's a fundamentally strong company, has given a lot of wealth for people who have bought it and held it. But at current market price, if you are a short-term trader, I will not advise you any buy here, because the trend is down. Let it at least cross levels of around, let us say 500. And then if it shows momentum, then yes, one can look at buying for trading purpose. But if it is for investing, yes, on dips you can buy this company, which has been a great wealth creator.
Okay, the next query is coming in from Gedam from Vishakhapatnam. He has bought around 234 shares of JSW Energy at a price of 535. Shall he hold or exit or average? Rudramurthy, any view on this?
Clear hold, clear average, and I feel because crude oil prices have gone up so much, these alternative sources like energy and power themes can do very, very good. In fact, even Coal India is one script which I like a lot at current market price. Risk reward is very favorable, and similar stock and similar theme will be JSW Energy. And if you see charts very clearly, 460, 470 has been a very strong support zone. At current market price, definitely I will be a buyer in JSW Energy. Look at targets of 560 initially on JSW Energy and buy at current market price. Keep a stop loss of around 470 for the long call.
Okay, the next query is query is coming in from Murthy from Vizag. Rupa or Kitex garment, which one should he accumulate now? Lancelot, any view on this?
So I think, both are going to struggle going forward. Number one is you still have the overhang of what's happening in the US and the US tariffs and how they're going to impact the garment industry. Second overhang is now that you have supply disruptions in terms of, the raw materials required for garments and for crude, etc., based raw materials that come in on the textile front. I think you are going to see further pain in the sector. So one should probably, exit or not invest in both these stocks at this point in time.
Okay. The next query is coming in from West Bengal. Call wants to know the outlook on RVNL. Lancelot, any view here?
So I think RVNL is, a lot of its business is only dependent on the India railway projects and infrastructure projects. The government has assigned a larger share of projects to RVNL, and you are seeing that since it has increased its allocation, RVNL is benefited. However, when you look at the valuations, it is trading at 47, 48 times earnings. And in order to, justify this kind of valuation, it has to at least grow at 50% year on year, which is not really the case. So the valuation being expensive, one should wait for a correction and then one should buy into the stock. Longer term, the outlook is definitely good.
Okay, Siva from Amravati is holding 10,000 shares of Rain Industries, bought at a price of 178. Can he hold for the next 3 months? Rudramurthy, any view on this?
See, Rain looks a strong stock, and yes, when metals also do good as a sector, this Rain also does along with it very good. So for me, Rain has a strong support at levels closer to 100. So at current market price of around 110, I will be a buyer in Rain and keep buying it on any dips to those levels of 100, which is a good price to accumulate, and keeping a strict stop loss of 90, I will be looking at targets of around 150 to come. So it is a 1:4 kind of a risk reward even at current market price. So buy Rain at current market price, add it on every dips to 100 with a stop loss of 90, look at targets of 150 to come. So definite buy at current market price.
Okay. The next query is coming from Santhi, and he's holding, he wants to know whether the current price is a good entry point for Narayana Hrudayalaya. Rudramurthy, any view on Narayana?
See, for me, yes, pharma is doing really good, and some of these healthcare related stocks can do good even from here. So yes, stock has corrected a lot from its top level, and at current market price and on any dips to these levels closer to 1,600, I will be a buyer. So buy Narayana Hrudayalaya at current market price.
The next is a caller query coming in from Pune. Swapnil, you can go ahead and ask your query.
Hey, good afternoon to you and everybody. I brought Reliance at 1450 or some 1300 shares. I want to know, should I average it now, adding more, or should I sell it?
That question is there in many viewers' mind. I have got multiple queries on WhatsApp on Reliance Industries given the sharp fall that we have seen. So let's first take the fundamental view here. Lancelot, should one average Reliance Industries at the current levels or avoid?
So if your outlook is, you're willing to hold on to the stock from at least 3 to 5 years, then one should look at adding to your positions, because, the fundamental business of Reliance will continue to grow. and the impact of the negatives on account of the crude situation will ease up over a period of time, and then things will go back to becoming a little bit more regular. So I think longer term, yes, the company is very strong in its business opportunities, and they're also looking at a listing of their GeoMart and retail businesses. So it will offer more value going forward. So one should either invest at lower levels or just hold on to the existing investment.
And Rudramurthy, any technical view on Reliance Industries? How's it looking on charts?
Sound very clear. If you are a short-term trader looking for momentum, in fact, the break has happened today on the downside. In market like today, Reliance is underperforming, and crucial support at around the 1310 has got broken in Reliance. So as a very short-term trader, definitely I will not buy this stock. But if you are a long-term investor, as our fundamental expert also told, if you have the time period of, let us say, 3 to 5 years, definitely yes, on dips you can buy Reliance. But as a short-term trader, wait, because today is the first day it is trading at the lowest level in last 1 week, and also it has broken crucial support at 1310. So I will not adventure a buy here, but for long-term investor, yes, you can consider.
The next query is coming in from Rajiv from Kerala. He wants to know what is it a best time to invest in Tata Motors commercial vehicle? Any targets or support levels that you could provide for this Lancelot for long term?
From a longer term perspective, I think Tata Motors, is, while the commercial vehicle business is primarily restricted to its India business, but we are expecting that, given this disruption in supplies, etc., you are going to see a little difficult year for Tata Motors commercial vehicle. And, that could have an impact on its profitability. So I think there's an opportunity to buy the stock at lower prices.
Okay. The next query is coming in from Ramesh from Chennai. He has bought 200 shares of Graphite India at a price of 718. He wants to know the view for the next 3 months. Rudramurthy, any view on Graphite?
See, at current market price, definitely the stock shows good short-term uptrend, and there is strong resilience in the stock nearby to the support zones of around 600. So at current market price, I will definitely be a buyer. If you have it, hold it. And I won't be surprised, yes, in the next 3 months time frame, what he is asking for, he can look at price targets of around 700 to 730. So hold on, buy even at current market price, look at targets of 700 to 730 and keep a stop loss of around 600.
The next query is coming from Ramesh from Bangalore. He has 10 shares of ICICI Pru AMC, bought at an average price of 2,660. Is currently sitting on a profit. Should he buy more or sell his share at the current juncture? Any view on this, Lancelot?
Yeah, I think the asset management business is going to continue to grow from a longer term perspective. While yes, there may be some impact in the short term because people may, they may not invest as much, as well as, market values go down, and based on which the fees of the asset management companies get impacted. But if you consider it from a 3 to 5 year view, one can definitely add to the positions.
Okay. The next is a caller query coming in from Bangalore. Sean, you can go ahead and ask your query.
Sir, I have this BDL 900 quantity, which I bought it for 1400. Can you kindly let me know what to do, sir? It is gone very low.
I know. Can you hold for long term?
Yeah, I'm looking for a long term only, sir.
Okay.
Long term means, can you tell me how long it is?
At least more than 12 months. Can you hold that?
Yeah, okay. I can hold it for 12 months.
Okay, Lancelot, so should Sean continue to hold this counter for long term Bharat Dynamics more than 12 months at least, because he's currently sitting on a loss?
So, if you look at a longer term business, and I'm saying long term is not necessarily only 1 year, it needs to be at least 3 to 5 years. The reason being, this stock is trading at 77 times its earnings. Now, while the outlook for business is good, it is very expensive even at this price. And you could have a short-term correction because if any quarters the financial performance is not good, the stock could be re-rated downwards. So if you're willing to hold it for minimum 3 to 5 years, yes, one can hold on to it. Otherwise, maybe it's worthwhile to average out if it does correct further, and maybe when it trades at around 30-35 times earnings, that would be a good time to accumulate the stock.
Okay. The next query is coming in from Venkat from Hyderabad. He has 44 shares of Cyient bought at a price of 2,231. Should he hold or average more? Rudramurthy, any view on Cyient?
Clearly, the stock is in a downtrend. It has broken all crucial supports, trading at the lows. So there is no strength. If it is for short-term trading, definitely avoid. Or I won't suggest an averaging out nor to catch a falling knife. You can look at switching over to other IT stocks relatively where there is strength. It can be either Infosys or even look at Tech Mahindra, which looks very strong to me on chart. So if you want to be in IT, be very choosy. And two top picks from IT from my side will be Infi as well as Tech Mahindra.
The next query is coming in from Sai from Andhra Pradesh. He wants to know whether is it a good time to buy Max Healthcare, given the fact that the stock is at its 52-week low. Rudramurthy, any view on Max Health?
I will definitely avoid stocks which are trading at 52-week low unless you understand its fundamentals so well and you are also having a long time horizon and you want to buy it for your portfolio. That's a different story. But then if I just go based on the chart pattern of Max Health and trading at the lowest levels in last 1 year, I don't advise any buy here. But yes, you have a strong support zone for the stock now, right at those levels of around 930, 920. So if you already have the stock and if you want to average it out and if your time horizon is long term, keep a stop loss of 900 and then only hold on to your existing positions or even average at current level. But a stop loss of 900 is a must.
Mr. Singh from Ludhiana has around 857 shares of Bombay Dyeing bought at a price of 109 rupees. Should he hold or sell? Lancelot?
So if you look at Bombay Dyeing, basically it's trading at 115 times its earnings. I think the major business now is in the real estate developments side, which is a long drawn business and where cash flows are going to be lumpy. So I think given that, we are seeing, some amount of saturation in that business and a little bit of slowdown expected, one should look at exiting if one can at this particular price point.
The next query is, the next query is from a viewer who is asking for some support levels for Hindustan Copper and whether should one buy at the current level. Rudramurthy, any view on this?
See, if you look at charts of Hindustan Copper, yes, there is a strong support for this stock at around 450 zones. At current market price, yes, I will be a buyer in Hindustan Copper. And if you get any dips to levels closer to 470, 480, you can buy. But do understand that this is a volatile counter and you have to have that kind of a risk-taking ability to buy these stocks, whether it is Hindustan Zinc, Hindustan Copper. They all move very fast, either on the upside or on the downside. But at current market price, yes, it looks a good buy because the stock has already corrected from those 750 zones to current levels of around 500. So I'll be a buyer at current market price. Buy on dips to levels closer to 470. Keep a stop loss of around 440 and expect a target to come at around 650.
Somashikar from Bangalore wants to know whether should he buy Hindustan Aeronautics at the current price for the next 2 years. Lancelot?
I think Hindustan Aeronautics, it is an expensive, stock because it's trading at a high multiple. But if one looks at the fundamental business, it is, growing and a lot of the government orders are coming to HAL. So one should look at, accumulating it. But currently valuations are more than 70, 60, 70 times earnings. One should probably wait for a decline in the price before one can accumulate the stock.
The next is a caller query coming in from Mumbai. Ankit, you can go ahead and ask a query.
Yeah, I wanted to know, hello all, I wanted to know about Sportking India. I have 500 shares at 120 rupees. I wanted to hold this for long term, at least 3 to 5 years.
Okay. Lancelot, any view on this counter Sportking India?
So from, this company is basically focused on manufacturing yarn and textile production. So in that sense, the business is relatively, very less. The profitability in the business is low. Sales growth has been pretty low over the last couple of years. And since there's not much, growth happening either in the sales nor the profitability, one should avoid investing in this company. There are a lot of other better opportunities with lower, with a better risk-reward ratio that can be looked at.
Well, with that, let's start our rapid fire segment. Lancelot and Rudamurthy would request you to keep your answers short to buy, sell or hold. The first one coming in from Rao from Hyderabad. He has 40 shares of Gulf Oil. Can he hold for next 3 years, Lancelot?
Hold.
Sambasiv Rao is holding 10 shares of PI Industries. Should he invest? Should he continue to hold this counter, Rudamurthy?
Hold.
Rajiv from Delhi wants the 6-month technical view on Trans Rail lighting. Rudamurthy?
See, if I see the chart pattern, it is on a downtrend, but now at a crucial support zone. So I will hold with a stop loss of around 450.
Varshish is holding 150 shares of Grow, bought at a price of 100 rupees. Should he continue to hold this, Lancelot?
Hold.
Okay. The next one is from Ramesh from Bangalore. He's holding 1,715 shares of Canara Bank, bought at a price of 136, currently sitting on a loss. Rudamurthy, should he continue to hold this counter?
Hold and also average out.
Well, with that, we come to an end of this segment of Ask Profit. Stay tuned and keep watching NDTV Profit. Thank you, Lancelot, and thank you, Rudamurthy, for joining us and solving your queries.
हर पल मनाओ केसरी त्योहार विमल बोलो जुबान केसरी.
Hi, I'm Tamanna Inamdar. Watch me on NDTV Profit, where I break down the day's biggest business stories. What happened, why it matters, and what it means for your money.
Hi, I'm Neeraj Shah. Watch me on NDTV Profit for the most incisive market intelligence and meaningful corporate conversations.
And I'm Alex Matthew. Markets, mutual funds, insurance, personal finance. I help you cut through the noise and make smarter financial choices. And here's where you can watch us.
Presenting the all-knowing, all-powerful Tech Guru.
Whoa. Guru? I'm no guru.
Okay.
I'm just a guy who loves his tech.
A show where the mysteries of megabytes and motherboards shall be unraveled.
Bro, nobody talks like that anymore. This is all about connected ecosystems, EVs and AI that you can use in your daily life. That's what we do on Tech 360. Real talk, real reviews, tech that you can actually use.
Tech has changed. So should your tech show.
To understand the Tamil Nadu twist, join me in the midst of our people, language and politics. Vanakkam Tamil Nadu, here we come.
When others are warming up, I'm raring to go. The stories that matter, the stories that shape your life.
Hello and welcome to watching Prime 5 with me, Ganesha Ecosphere. What's happening? How to
The show that sets the prime time agenda.
We'll be deep diving into this topic to tell you what's at stake.
Join me, Raisha Sehgal, on Prime 5 only on NDTV 24/7.
Will the rising sun win with a hand in hand? Will the two leaves and lotus bloom? Who will whistle to success in Tamil Nadu? To understand the Tamil Nadu twist, Join me in the midst of politics and people. Vanakkam, Tamil Nadu. Here we come.
Hi, I'm Tamanna Inamdar. Watch me on NDTV Profit, where I break down the day's biggest business stories. What happened, why it matters, and what it means for your money.
Hi, I'm Neeraj Shah. Watch me on NDTV Profit for the most incisive market intelligence and meaningful corporate conversations.
And I'm Alex Matthew. Markets, mutual funds, insurance, personal finance. I help you cut through the noise and make smarter financial choices. And here's where you can watch us.
New year. New power panel. India market open. Now in its stocks get conviction.
I'll recommend a buy call on a stock only when I'm fully convinced on the stock. With a table thumping buy.
Welcome, you're watching India Market Close, and what an exciting Monday closing session it's turning out to be. Largely because of hopes of a ceasefire. Alex, this is truly, telling about how the only thing, in a sense, putting pressure on the markets right now is what's happening geopolitically, and the first sign of that tension lifting, and look at how markets behave.
Yeah, absolutely. It has to do with that Axios report, the possibility, even the whiff or a sign of a ceasefire, a 45-day ceasefire is being spoken about, but nobody's sure about whether this is going to pan out. You still have a sharp spike in the market.
I think a few more updates since the Axios report this morning. So this morning, of course, that report that we put out, that a 45-day ceasefire is being mulled. That now got built upon with newswires reporting that there could be a ceasefire for after 15 to 20 days. That's when you saw this sharp spike. Iran, in a statement a few minutes ago, has said that the Strait of Hormuz might not be opened even if there is a ceasefire. So, of course, there is a fog of war. Markets have paused recovery because of the uncertainty on that ceasefire chatter. Reports say Iran-US hostilities end plan. Iran has rejected a temporary Hormuz reopening. This is what NDTV is reporting. Meanwhile, Reuters is saying we could see a final deal in 15 to 20 days. So there has been a technical bounce, but reversal is unconfirmed. If you look at the kind of lead we're seeing today, you have large private banks leading, Reliance is dragging, but value buying is continuing in small and mid-cap stocks. So the risk-off tone is gradually easing. Bond yields are also softening. You've seen the rupee strengthen, and you could see a sell-on rally. I think the big one, though, Alex, is going to be that press conference at 10:30 tonight, India time, where Trump, with the top brass of the American military, is going to be addressing the media. My guess is he may have those rescued fighter pilots there with him at that press conference as well.
It's all about showmanship at this stage, and you've seen a lot of saber rattling from both sides, right? Particularly over the weekend, you saw the tone and tenor of that social media post that everyone seems to be talking about. But let's take a slightly more deeper look at how the markets are right now. We're at the high point of the day, as we showed you for the Nifty 50, but let's look at the internals and look at Reliance Industries, which you will see at the bottom of your screen if you pull up the heat map for the Nifty 50. And ultimately, it is HDFC Bank that is balancing things out on the other side of the spectrum. You will see that in the contributions chart in just a moment, but take a look at that, 3.6%, a very heavy weight on the downside for the Nifty 50, but a stark change from what we saw in the morning, Tamanna. You had green only to this point approximately, and that is spread across the screen. What is looking good is Trent. Oh my goodness. What a story this is.
Not just Trent. Actually, look at the Tata Group stocks today. Trent, Titan, Tata Consumer, all of them shining. The fact that along with an HDFC, Bajaj Finance is pulling up, and L&T rebounding the way it is very telling to me, because L&T has been depressed because of this whole Middle East crisis situation and their exposure to those geographies. If you pull up the broader markets, let's do that very quickly as well and just give you a sense of what's happening there. The mid cap also doing phenomenally well at the high point of the day, 1.5% up. That climb there is good. Small cap, not so much, about 1% up. And the sectoral heat map will tell you that the story is going beyond just the business updates. What you were seeing in the morning was the business updates. So, save for the oil and gas, because
which is Reliance.
And you know, Brent is, if you pull up the latest, Brent is still high up there because all of the stock is there, but not too much going out of the Hormuz. And it's Reliance specifically which is in pain. We'll have a special report by Somit Sarkar in just a bit to tell you exactly why. But Brent actually has cooled off a slight bit at 108. So it's going to be painful. We should look at what Europe is doing very quickly because, you know, if this is definitely a situation where there is some easing, so at least the FTSE is now showing this, DAX also off its lows, about 0.5% down.
But we've also had much more carnage in our markets compared with some of these global markets. So I think to a certain extent that relief is warranted.
Yep. Hemang Kapadia joining us this afternoon. Hemang, very good afternoon to you. Are we seeing 23,900 sustaining, because that's where the Nifty seems to be oscillating?
A very good afternoon to you, Tamanna. Thank you for having me on the show. So it's a pleasure. 23,900 sustaining. I'm probably seeing 22,900 sustaining. I'm probably seeing 23,400 and 23,800. Markets are deeply oversold, Tamanna. I know this is obviously on the news of a pause in the war situation, but we were overdue for a bounce, and I think that's what is happening. I think the month of April, unless there's going to be some major new hostility, the month of April should be good for markets. In fact, if you see over the last 10 April, I believe 8 to 9 have been positive. So I would say a recovery, and a pretty good one at that, is underway and should be for some more time. Tamanna.
So, Hemang, hi, good afternoon, Alex here. And so, therefore, on the individual stocks, right, some of these frontline names, even if you look at it from the valuations lens, Hemang, a lot of people have argued that we are at very attractive levels, valuation-wise. If you were to buy into individual names, would you gravitate to some of these large cap stocks, and which ones?
Okay, hi, Alex. Yes, I think you guys spoke about HDFC Bank. I think that makes a lot of sense on technical parameters. But if you ask for my individual stocks, I would buy anything in IT. IT has been hammered out of shape. I mean, most of the market has been, no exception that way. But I believe IT is going to be positive for the month of the month of April. So if I have that freedom, I'd like to buy TCS, Alex, at 2470, stop loss 2420, target 2570. And the other, my stock pick, Alex, if I can give you, Radico Khaitan at 2660, stop loss 2610, target 2760. Both of these are looking good. And like I said, anything in IT and anything in sugar, Alex, sugar is posting a longer term bottom. IT is posting a short to medium term bottom. Alex.
Okay, fair point. All right, so anything in IT, interesting, right? Pull up the IT index as a whole and see where it is at. And I wouldn't be surprised if it's at the high point of the day. Remember, it's had a wobbly, so it's not. It's cooled off just a tad bit. If anything, I think it's the Nifty Bank that is at the high point of the day. And it's had a wobbly day so far as well, up about 1.8% or thereabouts. It has underperformed in the recent past. But let me go across now to Sharad Dubey, who's joining in to tell you about the stock of the day. We spoke about Trent briefly. It is the best performer in the Nifty 50 and finally having its day under the sun.
After a long time, Alex, and the momentum which is there in April month, it's a double-digit return already and just 2 trading sessions is there. Interesting stock and interesting update coming in. The revenue growth you see and compare with the last 2 quarters, and Trent has done really well. The range was roughly around 17% at an average, and this time it's at 20% in this quarter. Now, the average revenue per square foot, however, that has reduced. That's around 2.8% of degrowth coming in. And the business update, if you look at it, overall, the revenue has jumped 20%. And the sale from merchandise, if you look at that, That level is also up 21%. Now they've opened 22 West Side stores and also 109 Zudio stores. So that is something which the street is liking out for. But going ahead, there are some triggers to watch out for. A stable like-for-like growth is expected in the fourth quarter numbers, a throughput ramp up in the new stores, that numbers we already saw in the operational update, and the sustainability of this. This is very much important. But let's look at valuations. How does this actually pan out for Trent? The highest PE valuation was 104 times in February 2025 last year. The 5-year average still on the higher side, 131 times, and the current levels, it's at the lower side, 81 times. And if you look at the forward, that is still at the lower side at 73 times. So of course, valuations are definitely high, as analysts talk about, but looking at its average numbers, it is still on the cheaper side. Let's look at the guidance, how things pan out. Almost 20 to 25% of guidance is expected to come in, and management is expecting more traction to come, at least in the medium term. Brokerage views also, let's have a look. Citi has given a cautious stance due to competition and store cannibalization, while Morgan Stanley expects Q4 standalone EBITDA margin to improve by 100 basis points. And lastly, Macquarie believe that the same store sales growth momentum has improved. So we can see a mixed reaction coming in from the broking houses, but the markets have clearly given a thumbs up for Trent.
Got it. All right, thanks so much for that, Sharad. Let's bring on board Ashish Chaturmota, Managing Director and Fund Manager at Apex PMS JM Financial. Ashish, thanks so much as always for taking the time. I wonder if you heard some parts of what Sharad just described on Trent about the fact that brokerages are still divided. I wonder what your view is, particularly on the back of a pretty healthy quarterly update and a sharp uptick in the stock price.
Yes, hi. So, see, as far as a lot of these retailers are concerned, whether it's a DMart or a Trent, Vishal Mega Mart, V2 Retail or V-Mart, we see what we are observing is this is a complete divided. So if you look at companies like DMart and Trent, both are trading even today at a very, very high multiple. But if you look at the growth, so for example, Trent is now going to grow at 20-22%, but still trading at a very high PEG ratio. Same is the case with DMart, which is seeing a very, very strong store additions and seeing strong sales growth also. But at the same time, if you look at the top line growth versus what the PE multiple we are going to pay, it looks little expensive. But same way, if you look at some of the small players who are more into tier 3, tier 4 markets like V2 Retail or Vishal Mega Mart, we think these companies are showing much better growth with reasonable valuations. So our view is that as far as Trent and DMart is concerned, it could be a tactical opportunity to play out in the shorter term time frame. But from a long term perspective, it looks like the stock is going to consolidate in a broad range for a very long period of time. Whereas the risk reward looks very promising from a medium to long term perspective in stocks like V2 Retail, Vishal Mega Mart, and there are some other players, but preferably our topic would be V2 Retail and Vishal Mega Mart.
Okay. So why don't I go to you, Hemang, very quickly on some of these names, right? So doing particularly well in trade today, Trent, Vishal Mega Mart, even a DMart on the back of that quarterly update. Would you buy into any of these on the basis of technicals?
Trend looks very promising from a medium-term point of view, Alex. 83.45 to 32.75. And if you take the swing high in July of last year, 6,200, it became half or almost one third.
Hemang, sorry, I might have mistaken those numbers. Could you repeat the range that you were talking about?
Yeah, if I'm talking about Trent, Alex, it's come off from a high of 83.45 in 24 October to 32.75. If I take the swing high, Alex, in July 25, that was around 6,261. So from there also it's become half. So it's virtually fallen off a cliff, deeply oversold, downside limited. We saw a reversal last week. We saw an upward bar reversal coming in. Gap up, indicators positive. Everything seems to suggest, okay, it's moved up quite a bit today. So probably from that point of view, even DMart has moved. So Vishal Mega Mart is technically cheaper. Then it would be Trent, and then it would be DMart, because DMart has moved from 36.50 to 45.50 in a matter of 3 weeks. Alex.
Okay. Hemang, stay with us. Ashish, stay with us. Speaking now with Amish Shah, Head of India Research at BofA Global Research. Amish, very good afternoon to you and great to speak with you. You know, when we were discussing your report this morning, things were looking much gloomier than they are now. But then again, that is the nature of the world that we currently live in. I just want to come to you on your Nifty outlook for 2026. And of course, it has been cut significantly and understandably. What do you think are the residual pain points India will see when this war situation eases? Because it will happen sooner or later. But what is the damage that has already been done to corporate earnings in India?
Absolutely. First of all, thank you, Tamanna. Always a pleasure talking to your team. So look, I think the damage is more in the on the front of macro and commodities. So even if the conflict were to end immediately, it will take some time for energy supplies to come back to normal. And as a result, we do think that the crude, which was at around $60 a barrel prior to the conflict, is likely to stay elevated for the rest of the year. We are working with a target of 92.5 for the year as a whole, which basically means $100 for the residual year. And as a result of that, and that aside, obviously there is impact from natural gas, LPG, all of these put together. We do think that the GDP growth, which we were estimating at 7.4% earlier, is now likely to be more like 6.5%. Fiscal deficit, which was budgeted at 4.3, is likely to be 5. Inflation is going to go up. We are also talking about 50 basis points of interest rate hikes. So all in from a corporate earnings perspective, we do think that FY27 earnings could settle down at 8.5%. Much lower than the consensus at 15 as of now.
So that's a sharp cut. But even for the Nifty target to go from 29,000 or to 26,200, are there some sectors or stocks that you think would be relatively unscathed or less hit, Amish?
Absolutely, Tamanna. So there are some obvious sectors, like let's say the regulated power utilities. They are, as the word suggests, they are regulated and therefore they are on guaranteed profits. So conflict or no conflict, their profits does not get impacted at all. So those I think, are definitely going to be outperforming. IT is another sector where we think that because of the conflict, rupee, as we know, has depreciated. And while on a long-term basis, we are not that optimistic on IT, but in the near term, clearly IT stands out as a sector that in fact benefits from a rupee appreciation. Pharma is the next one. And then we do think that some of the capital marketplace on increased volatility will see in fact increased business. So some of these we think are beneficiaries actually. And if you believe our view of rate hikes, then banks, SOE banks, some of these rate sensitives will actually see NIM expansion as a result of the rate hikes, so they will benefit as well.
Okay, very interesting. Amish, good afternoon, Alex here. So one line in the report was that markets are not yet at true value zone or in a true value zone. And from the layperson's perspective, they've looked at 2 years of relative underperformance and a crack, particularly over the last 1 month. But having said that, valuations haven't come off very dramatically. Of course, they've come off, but compared to average over the last many, many years, we're still above, aren't we?
Absolutely. So you see, valuations you can cut in multiple ways. So you can look at valuations of Nifty compared to its own history. You can look at Nifty in comparison to emerging markets. You can look at equity valuations compared to bond markets, and so on and so forth, right? So as of now, when we look at the valuations as a totality, because of the conflict, while Indian market sold off, so did some of the other emerging markets as well. So on a relative basis, India's valuation premium to emerging markets is still quite elevated. And as a result, India in the context of EMs is not still that attractive. Secondly, bond yields, as we know, has gone up from 6 to 7.1, and as a result, bonds versus equities, the equation is still not completely in favor of equities as of now. But Nifty, in comparison to own historical valuations, has obviously come off, and that is an encouraging sign. So that's why I would say that valuations have become reasonable, but valuations are not really in a deep value zone. So you will make money, but if you're a foreign investor, you would possibly make money in other emerging markets as well. So therefore, our view that India will underperform EMs, but from the current levels has a potential of giving you a 15% rupee returns. So I guess if you're a retail investor in India, you could play for that 15. But if you're a foreign investor, you are going to compare that 15 minus the rupee depreciation, and that in comparison to emerging markets like Korea, Taiwan, China, etc., where India does not stack that well.
That's a fair point. I do want to ask one last bit, which is, why is this different from a COVID-19, say, for example, or a certain other crisis that you might have seen between 2010 and 2020? We're actually seeing significant damage, Amish, being made to oil infrastructure. And so you can have perhaps a year, 2 years, 3 years, 4 years, maybe in certain situations where this infrastructure limps back. So therefore, is this going to be a protracted period of higher commodity prices and thereby scrimping of margins for corporate India, various other problems geopolitically, leading into balance of payments problems for India? Is that why this is different?
Well, yes, Alex. The short answer is yes. While we agree that the damage to the energy infrastructure because of the conflict has been there, and commodity prices as a result will continue to stay high, so let's put numbers. So 50, as we know, 15 million barrels of oil per day is what is basically getting disrupted. But there are going to be alternative supply routes. Once the Strait of Hormuz opens up, then maybe we could argue that production can ramp up quickly, and over a 4 to 6 months period, there is at least some solution in sight. During COVID, that disruption was far too long. So that's point one. So the way to think about it is that for FY27 as a whole, will the prices of energy stay elevated? Answer is yes. Will it continue to stay high in FY28? Debatable. If the conflict ends soon, as some of the news is doing rounds today, then I think by FY27, or in fact by second half of FY27, there will be a solution in sight. So I would not particularly worry about FY28 earnings, whereas during COVID, things had just come to a stop. Construction activity, people movement, all of that, had a very large and a protracted impact on earnings, which doesn't seem like this time around if the conflict comes to an end.
Amish, when you're seeing some of the initial business updates coming in, and I know it's for a period that is pre-conflict in that sense, but as far as financials are concerned, some of the consumption stories, retail stories looking very exciting. And I know these are trailers, not the full picture. Do you think that there is inherent strength that in corporate India's performance that the market is not willing to look at right now because of overriding factors, and these will come to the fore?
Absolutely, Tamanna. So I guess, if you just rewind back prior to the conflict, the excitement was that Indian government has done 2 rounds of fiscal stimulus in the form of direct tax cuts, GST cuts, and then there was 125 basis points of monetary cuts, plus there was liquidity, plus there was easy regulations from the RBI. So clearly, it seemed like we had marked the bottom in terms of corporate earnings, and corporate earnings growth was going to accelerate. So the strength of the economy was already there, and macro was looking in a very good shape because current account deficit was less than 1%, fiscal deficit we were constantly consolidating, rupee had started to stabilize. There was in fact view that we will cut interest rates further on the back of Fed possibly cutting interest rates post-June once the Fed governor changes. So all of that was basically economy already coming out of a slowdown and actually wanting to accelerate. So for the time being, because of the inflation and the growth impact that the conflict has brought in, a couple of quarters, we think that there will be damage, which is what we've already priced in our earnings estimates. But thereafter, I do think that if the conflict ends soon, the inherent strength in the economy will come back, and that is clearly something that the markets doesn't want to price in as of now. But obviously, it's all the duration call. In case if the conflict drags on, then the impact on corporate earnings is not going to be a linear function. The deterioration is going to be quite rapid.
Okay, Amish, as makes sense, there's of course different scenarios that you've painted in the report that you've put out today as well. What is the worst case scenario that you're seeing play out, and the possibility of it right now? Just want to understand if that was more of a intellectual exercise, because of course every report has to look at all scenarios, or is that something that you see possibly happening?
So Tamanna, the worst case is obviously the threats that are doing the rounds, that there is going to be a damage to the energy infrastructure, the power plants, oil, gas, fields, etc. If that happens, clearly to Alex's point, that the revival of that infrastructure will take several years to rebuild, and in the meantime, a lot of supplies of crude gas is off the charts, and therefore crude prices, natural gas prices will stay much elevated, even further elevated from where we are for a very long period of time. That is your real worst case, and in that case, then the impact is not just for FY27 earnings, but it will spill over to FY28, possibly even FY29. And if it is going to be that protracted an earnings impact, then clearly the valuation multiples will also respond by contracting. So taking the cue from COVID, which was a long-lasting impact, valuations for Indian markets had gone to as low as -2 standard deviation. We are currently at long-term averages. So then you are talking about impact on growth, plus the impact on valuation erosion. That is a worst case that we talk about. It could be a scenario. We all hope that that is not a scenario that we go through. But otherwise, we do think that if the conflict ends, which is the base case that we are working with, then there is a 15% upside potential. Okay. If the conflict drags on for another month or two, then we think that there could be a 8% downside from where we are.
Okay. Even if it ends but in a month or two, then we're looking at further pain. Got it. Thank you so much, Amish, for coming in and speaking to us. We always enjoy our conversations with you and the clarity that you bring to all of your answers. Always a pleasure. At the baseline of all of this is the question about what happens geopolitically, and that's the report that we want to get you. So many reports in the last hour or so, and you're actually seeing the impact of that on your screen. If you pull up the Nifty intraday, you have reports from Bloomberg, Reuters, all agencies putting in different versions of what they think is happening. But I want to go across to NDTV's Pradeep Datta, who is joining us live from Tel Aviv to give us a sense of what he's picking up on ground. Pradeep, great to speak with you. The reports that we're getting and what markets are reacting to is the possibility of a ceasefire or talks of a ceasefire. Now, soon after that initial report, there's been a response from Iran saying that even if there are talks for a ceasefire, the Hormuz will not open. What are you picking up?
See, what we have got to know from different sources and agencies is that temporary ceasefire is something that is not acceptable to Iran. They are saying that for temporary ceasefire, they are not going to open Strait of Hormuz. That's what actually has been conveyed. Though the only green shoot we can see right now is that Iran is reviewing some of the peace proposal, because problem is that there is a trust deficit between Iran and the United States of America. Their argument is that they had gone for the ceasefire even in Gaza also, but everything remained on paper. Never ever the words were translated into action. So they do not want the same thing to happen to them, because they know this Strait of Hormuz is a kind of a bargaining chip for them, which they can use on the negotiation table. And once they give up on Strait of Hormuz, automatically they'll be losing the dominance over the region, and also America will start dictating them terms. That's one of the reasons that they are not agreeing to it, because they want the hostilities to end forever. Because we have seen already some of the regional players, they are trying to play a role of an interlocutor, mediator. Even there has been a proposal from the Pakistan side. He is in touch. Pakistan's General Asim Munir is in touch with J.D. Vance, Vice President of United States of America, and also in touch with the Iranian counterpart. So he is in touch with them also. But so far as Pakistan is concerned, because one can't take Pakistan seriously. Yeah. If we talk about Pakistan as a country, if you look at its track record, they had always been fishing in troubled water. But Pakistan had never ever been a country that has ever tried to bring end to conflict. But they had always tried to stoke conflict. So let's see how things are really going to pan out. At the end of the day, one man is going to decide whether there's going to be ceasefire or not, whether there's going to be peace, and that is Donald Trump.
Absolutely. Pratik, thanks so much for taking the time and for explaining all of this to us. Very important update there. Let's go across now to James Dorsey, Senior Fellow at S. Rajaratnam School of International Studies. And we've been speaking to James through this conflict, and we appreciate that he's joined us once again to give us his perspective. James, thanks so much for taking the time. Let me ask you what you make of the potential for a ceasefire at this moment, because we're seeing contradictory reports in some sense coming through. What do you make of all of those moving parts right now?
Always a pleasure to be with you. I don't think that we're seeing a potential for a ceasefire. What we're seeing is a desperate effort by the mediators, led by Pakistan, to figure out a formula that would at least temporarily end the hostilities. The proposal on the table is that fighting would stop for a period of 15 to 20 days, during which the United States and the Iranians would negotiate a permanent resolution to the Strait of Hormuz. We don't know that the United States has accepted that proposal, even though it's been put forward to them. What we do know is that the Iranians aren't going to accept it. They have leverage at this point, and they're not going to give up that leverage for the possibility of an agreement. They're going to give it up for an agreement. So I don't think that we're seeing a potential ceasefire at this point. What we're seeing is motion without movement.
Are we clear, James, on who the participants are, who the stakeholders are on either side? Because that's where it really gets confusing. When the US says it's talking to the Iranians, who exactly are they talking to? Because every visible communication from that side seems to refute any existence of talks in the first place.
I think what we're seeing is not talks, even though there may have been some direct messaging backwards and forwards. But we're not seeing talks between the Iranians and the Americans. We're seeing talks with the mediators who are speaking to both sides. In addition to that, the Western intelligence has put out reports that the American negotiators don't know who to talk to in Iran. There's no verification of that, of those reports. Fact of the matter is that the foreign minister, Abbas Araghchi, has been the interlocutor for Steve Witkoff, President Trump's special envoy, all along, going back to last year. Fact of the matter is that the Israelis took off their decapitation list both Araghchi, the foreign minister, and Galibaf, the parliament speaker, because they were the interlocutors with the intermediaries. And finally, we've seen regime cohesion in Iran since the beginning of this war. We haven't seen the regime speaking with different voices to different audiences.
That's a fair point, and that's exactly what I want to ask you about, James. Sitting here in India and perhaps in various parts of the world, the tendency is to focus on the messaging by one individual, right? And you're looking at social media posts over the weekend where expletives have been used, etc. My point to you, or my question to you, as somebody that studies this space so closely, is how much attention, in your opinion, should be given to what one person is saying in this, and how much should be given to the actual diplomatic channels?
I think as a journalist, I treat whatever anybody says with a grain of salt and look for verification of that. Keep in mind that what we're seeing is a fight on the ground, a kinetic fight, but we're also seeing information wars in which parties try to spin the narrative. And that's very much the case with regard to the talks or messaging going back and forth. With other words, by saying, for example, that the Americans aren't quite sure who to talk to in Iran is basically a justification of the decapitation strategy that has taken out senior political officials, including the supreme leader on the first day of the war, a host of military leaders. And the implication of those reports is that there's disarray in Iran. We haven't seen any signs of that disarray, at least any clearly visible public signs.
Just one last point, James. What do you think is going to come out of Trump's address later today?
More of the same, I would expect. I think Donald Trump is in a bind. He's in a very difficult position. And I think that last night's tweet with the expletives in it is a demonstration of the degree of anger that the Iranians aren't doing what the Venezuelans did, and frustration. But Donald Trump needs to, one way or the other, be able to credibly and unambiguously declare victory. Right now, even though they've been very successful in their rescue and search operations for the two pilots, and the fact that they do have superiority and have inflicted severe damage on Iran, fact of the matter is that's not a victory. And and therefore, the problem that Trump has is, in order to declare a victory, he has to score a victory by expanding the war.
Okay, thank you so much, James, for speaking with us. Always a pleasure to have you on. We'll take a very short break, but just going to that break, look at what markets are doing. Some new winners cropping up. I want to pull up BSE. I want to pull up AB Capital. If you can just pull up the intraday of both, showing some smart moves. Banks are the one that are ruling the roost. The Nifty bank about 2% up, and of course, the Nifty stays above the 22,900 mark. We're coming back with all the top ideas for buy today, sell tomorrow. Stay tuned.
हर पल मनाओ केसरी त्योहार विमल बोलो जुबान केसरी.
Hi, I'm Tamanna Inamdar. Watch me on NDTV Profit, where I break down the day's biggest business stories. What happened, why it matters, and what it means for your money.
Hi, I'm Neeraj Shah. Watch me on NDTV Profit for the most incisive market intelligence and meaningful corporate conversations.
And I'm Alex Matthew. Markets, mutual funds, insurance, personal finance. I help you cut through the noise and make smarter financial choices. And here's where you can watch us.
Presenting the all-knowing, all-powerful Tech Guru.
Whoa. Guru? I'm no guru.
Okay.
I'm just a guy who loves his tech.
A show where the mysteries of megabytes and motherboards shall be unraveled.
Bro, nobody talks like that anymore. This is all about connected ecosystems, EVs and AI that you can use in your daily life. That's what we do on Tech 360. Real talk, real reviews, tech that you can actually use.
Tech has changed. So should your tech show.
To understand the Tamil Nadu twist, join me in the midst of our people, language, and politics. Vanakkam Tamil Nadu. Here we come.
The stories that matter, the stories that shape your life.
Welcome back. Nifty close to its day's high, and look at how banks are shining. Axis Bank. I just want to pull up Axis Bank, and I know we've been speaking about RBL, we've been speaking about HDFC, but Axis Bank is zooming there. So you have a lot of excitement coming in that end as well. But what's the buzz coming in from the corridors of Dalal Street? Soumit Sarkar joining in with that segment we all wait for in the afternoon on what's heard on the street. Are you hearing a lot of joy or sighs of relief today, Soumit?
Well, clearly a sigh of relief. The markets gained nearly 450 odd points from the day's lowest level. But one stock that has been a disappointment is Reliance Industries. High sell flows on the institutional desk is what dealers have indicated, and this is largely because dealers indicate that the street expectations for the fourth quarter numbers are on the weaker side. In fact, EBITDA number for Reliance Industries, at least based on estimates, is expected to be largely flat on a sequential basis, and hence this weakness coming in when it comes to the share prices, because street was expecting, given the higher GRMs and higher crude prices, there could be some gains coming in for Reliance Industries starting from the fourth quarter. When it comes to Jindal Steel, sell flows on the hedge fund desk, specifically dealers indicate that the fourth quarter could be on the weaker side, and apart from this, higher iron ore prices is also one of the reasons that could weigh on Jindal Steel going forward. When it comes to Eternal, there are buy flows on the large HNI desk. The buzz on the street is that Blinkit profitability could be higher and better compared to what the company had reported in the previous quarter. For delivery, there are buy flows on DI desk. Delivery volumes are also expected to be on the higher side. And for Aurobindo Pharma, there are buy flows on the PMS desk. Amoxicillin prices have risen to around $32 to $35 per kg, and this improves the realization for Aurobindo Pharma by around 17% and will also support the company's Penji project. And lastly, when it comes to Bosch, that stock has been gaining. There are buy flows on the large HNI desk. There are rumors again of consolidation of the Bosch India subsidiaries, and on the back of these rumors, the stock has gained nearly 4% in trade.
Absolutely. So all buzzing stocks, Soumit, that you've spoken about, but I want to ask you specifically on Reliance Industries. The buzz on the street, of course, is that there's going to be a relative underperformance on the earnings side, but how significant would this underperformance be?
Well, the street is expecting that the EBITDA could largely be flat, and this is because there were some or the other disruptions in the O2C segment, and these disruptions were related to crude deliveries, freight and insurance cost going up, and the marketing segment, if you look at that, also could get impacted because at the end the retail fuel prices were largely unchanged despite the fact that crude oil prices had moved up significantly higher. So these could impact the O2C segment of Reliance Industries. When it comes to telecom segment, the growth is expected to be on the lower side given the fact that there were no tariff hikes, and subscriber additions have also been muted compared to the previous quarter and compared to its peers. When it comes to the gas exploration segment, that could report a weak set of numbers, but this could be because of lower production and higher costs. However, we do not have any clarity on that front. This is just based on expectations. And lastly, the retail segment, that could be a savior for Reliance Industries in the fourth quarter because its peers like Avenue Supermarts, Trent, Senco, Nykaa have reported strong growth on a YY basis. So that could translate into a good growth for Reliance Industries as well. But if retail also reports a muted set of numbers, then overall the numbers for Reliance Industries could well be much on the weaker side. And valuations are also largely at par with its 5-year average. The 12-month forward valuation stands at 20 times, while the 5-year average valuation stands at around 21 times.
Okay, thank you for that, Soumit. All right, what you're seeing on the side of your screen is a live interministerial briefing on the war. We're keeping an eye on it. You'll see the flashes, and we'll cut in as and when it's required to as well. So watch that space. Meanwhile, Siddharth Khemka, Head of Research Wealth Management at Motilal Oswal Financial Services, joining us this afternoon. We're also speaking with Nagaraj Shetty, Trader RA at HDFC Securities. He, of course, looks at technicals as well as derivatives. Welcome to both of you. Nagaraj, I want to come to you first, really, on the Nifty, the high point of the day. Do you think that an important level has now been crossed convincingly, in your view, with the strength we're seeing? Let's talk about Nifty as well as Bank Nifty, actually.
Hi, good afternoon. Yes, Nifty, the way it has bounced back from the lower levels is indicating that 22,200 is going to be an important support for so far. And market is now inching towards to breakouts of around 23,000 level immediate resistance. Once it moves above these levels, the overall chart structure is signaling some kind of a reversal pattern unfolding from the lower levels. That is good indication, and a further up move from here onwards could take Nifty towards the next hurdle of around 23,500. Bank Nifty, similar kind of thing unfolding. Even Bank Nifty is outperforming the Nifty over the last couple of sessions. The way it has bounced back with the more upside towards 54,000 levels in the near term.
54,000. Okay, so would you have a buy call therefore on the Bank Nifty?
Yeah, I would like to issue the buy call in the Bank Nifty, and currently 52,635. If you look at the Bank Nifty future, Apple future is currently trading around 52,925 levels. One can look to accumulate at this point of time. At least 54,000, 1,000 points of rally could come in the short period of time. One can place a stop loss at 52,500 odd levels.
No, we might have been significantly higher. We might be well above the 23,000 mark for the Nifty 50 if it wasn't for Reliance Industries and its underperformance, right? So Siddharth, what do you make of the possibility and this buzz on the street that you might have a weak number on the EBITDA front for Reliance Industries in the fourth quarter?
Yeah,
good afternoon to you, Siddharth, first.
So, Alex, if you look at, definitely there is a pressure on the core business of Reliance, which is the O2C business. And we have seen that the disruption in terms of supply, that has been a key factor. Then the second one is the entire retail pricing being capped, and hence the oil business witnessing some kind of pressure. Plus, because of the lower supply, the volume growth in the chemical business could also be disrupted to that extent. So that's on the core business. On the telecom side, again, the street has been waiting for the tariff hike, which has kind of remained elusive so far. I think it will be some more time before we see that tariff hike coming in through. The only silver lining for this quarter that we are looking at is the retail business, where things are definitely looking much better. A low base of last year, but definitely the discretionary spending across several retail companies, jewelry companies, the business update that have come in has shown that there is definitely an uptick in the fourth quarter. So overall, I would say a flattish quarter, but that is likely to disappoint and the markets, and hence the stock could remain under pressure for at least some more time.
Okay, Siddharth, just one broad view. I know you spoke about Reliance, but see, if you look at some of the business updates, what's the big trend you're saying? Are you looking at the excitement about banks basis the Q4 business updates as justified right now, or is this a recovery momentum?
Tamanna, I think if you look at on both fronts, we were looking at a good recovery in the banking earnings driven by the credit offtake. Now we are seeing that the deposits growth that has also been pretty healthy, and that is driving some of the the positivity for these stocks. So if you look at the systematic credit growth stood at 13.8% for the quarter, and the momentum remains robust, supported by the liquidity buffers plus the consumption-led recovery after the GST cut. So that is also helping both some of the discretionary sectors as well as the banks. And we are expecting, while in any sector, the same is the trend, there will be divergent outcomes. Some of the large private banks like ICICI, HDFC are expected to report flat margins. Axis, Kotak Mahindra Bank are likely to report a decline. While the mid-sized banks that we see are better placed, AU, Bandhan, Equitas, they are likely to report a NIM expansion. So I think there is a positivity built in the Q4 numbers that is supporting the uptrend in banks, and B, definitely being the highest weightage in this Nifty, and being a high beta sector, if there is a recovery in the market, banks will perform. And we have seen a sharp fall in the last couple of weeks. So I would believe valuations also becoming comfortable for some of the large buyers to get into these names. So I think it is a mix of fundamentals plus the sentiments for the market changing that is driving the stocks for banks in the near term.
Okay. Stay on with us, Siddharth and Nagraj. We just want to focus on a few stocks that are moving today. NMDC is one of them, back in focus after announcing another sharp hike in iron ore prices. It's the third increase this year. Move, of course, reflecting strong demand conditions and higher global prices, and is expected to lift NMDC's margin. That stock, of course, nearly 4% up. Parth Goyal joining in with more details.
Thanks a lot, Tamanna. So NMDC has hiked its iron ore prices by 10 to 11% from 5th April of 2026. They have hiked their lump prices by 10% to around 5,300 rupees per ton, and they have also hiked their fines prices by 11.2% to 4,500 rupees per ton. Now, this is the company's third price hike in 2026. Before this, NMDC hiked prices by around 3% in March 2026, and before that as well, NMDC also hiked its prices by 2% in the February month. Now, there are three reasons behind this recent hike. The number one reason is that the seaborne iron ore prices are up 8% due to the disruptions in Middle East. The second reason is that the steel prices in domestic market have been high due to higher demand. And the third reason is that the restocking demand has been high as well due to the good steel production that is happening in the domestic market as well. Now, coming on to the impact on NMDC of these hikes is that this will boost the EBITDA margins and profitability of NMDC. The company already saw a record production of 53 metric tons in FY26, which registered a growth of 21% year on year. The FY26 sales volume of NMDC also saw a growth of 13% year on year to 50.23 metric tons. And this recent price hike is signaling a strong growth in volumes as well as realizations for the company.
Interesting, very interesting. All right. So volumes are going up and there's also a boost to EBITDA margins and profitability. Siddharth, on NMDC specifically, would you be positive? And if not this, then any of the other commodity players?
So definitely, Alex, I think we are looking at a uptick in the commodity cycle, specifically driven by the improving demand for some of the base industrial metals like copper, zinc, aluminium, and hence we believe the entire cycle that is likely to do well. The increasing demand for power transmission distribution, that is also driving the demand for iron ore, and we believe that NMDC, Coal India, some of these mining companies are better placed compared to some of the metal companies directly because they are largely domestic driven, and we are seeing the price rising both for the coal as well as iron ore. So in NMDC's case, we are seeing that overall volume growth is improving, realizations have been better, and management is focused on ramping up volumes, capacity expansion towards that 100 MT target over the medium term, plus the strong cash flows that are expected to sustain, improve the balance sheet positions NMDC much better compared to some of the direct metal stocks. So we definitely have a positive view on NMDC with a buy rating, and our current target price is about 100 rupees.
Okay, as we're celebrating the markets recovering, and you're going to feel that heat maybe in your favorite beverage, because as packaging companies feel the heat of Iran war and cost of packaging rises, beverage companies may hike prices to cover up for input costs. Ridhima Bhatnagar is here with more details. Ridhima, as we get into a really hot season, I think everyone's favorite cooler, whether it's cola or something else, will start costing a little more.
So beverage prices could go up by 6 to 7% as per the analysts, and this is mainly due to the rise in input costs which have risen for the alcoholic and non-alcoholic beverage makers. Now, associations have told us that they are already contemplating a price increase. Remember that alcoholic beverage makers cannot increase the price without the state government approving it, whereas the non-alcoholic companies can do so based on the market forces. The prices are mainly rising due to the packaging costs, which have increased by 30 to 40% as per the beverage associations. Your stocks in focus include United Spirits, United Breweries, and Varun Beverages, to name a few. Now, these packaging materials which have increased in cost are glass, your PET bottles, plastic caps, and cans. In March alone, glass prices have increased by 8 to 12%, whereas cans, which use aluminum, the aluminum prices have alone risen by 8%. PET prices have also risen by 40%, and your plastic caps are also seeing a price hike of about 30%. If we talk about the packaging mix, now alcohol companies use 80% glass and 20% of PET for plastics, and beer companies use 80% glass and 20% cans, whereas non-alcoholic beverages companies use around 80% of PET and rest is glass.
Okay.
Now, how much the price increase is something we need to closely watch.
Okay, so 6 to 7% could be the extent of price increase which goes. And I want to pull up the Radico Khaitan stock has been on the top of our technical analyst list since this morning, and is doing pretty decently as well. Come off its highs, but about 2% up right now. Nagaraj, I want to go into BTST calls. 10 minutes to go for markets to close. There's a big press conference later this evening, India time, 10:30 p.m. We don't know what the US president will say. Would you have any buy calls positioned?
Yeah, I would certainly, by looking at the market, the way it has recovered, I think there is a higher possibility that Nifty could move above the immediate hurdle of around 23,000 levels in the short term. On that basis, whole sector, front sector are moving up, and even mid cap and small caps are showing a very well bounce back from the lower levels. On that front, I have two stocks from the long side. First is one gold financing company, Kalyan Jewelers. Chartically, this stock has been in a constant downtrend amid the consolidation over the last 1 month, and before bouncing back recently from the lower levels. The formation of fresh high tops and high bottoms on the chart is indicating a fresh breakout in the stock price. Currently trading around 419.90, 420 levels. One can look to buy at this point of time. 445 is going to be the immediate target, and one can place a stop loss at 405. Second one is Ramco System. Ramco System was beaten down stocks over the last few months, and from the lower levels, it has bounced back very well from the low of around 340, 342 levels. Currently showing around upside above the immediate hurdles. Now trading at 384 levels, one can look to buy at this point of time. The immediate target would be around 405. One can place a stop loss at 375.
Okay, so Ramco and Kalyan, how would you look at some of the gold companies, Siddharth? All of them shining today, even a Muthoot picking up in last trade. Of course, Senco on the basis of those business updates, Titan doing well, and so is Kalyan.
Yeah, I think if you look at the other two segments, the gold jewelry company as well as the financing company. So I think the NBFCs, they are doing pretty well because of the gold prices that has run up. The sentiments definitely took a beating once the gold prices came off. But I think in terms of earning wise, they are going to report strong earnings. Similar is the case with the jewelry companies. I think our preferred choice would remain with Titan. They have been reporting strong quarter. Q3 has been pretty strong. Q4 also looks to be pretty steady. And we believe that with Titan's superior strategy, both in terms of their sourcing, their improving trend in terms of the studded jewelries, they have been reinventing, and there is a lot of focus on the youth with the rebranding as well as some of the newer sub-brands that they have launched from time to time. We believe that a consistent compounding machine like Titan that can continue to grow at 20-25% earnings CAGR over the next 2-3 years is a stock to look at in this market.
Okay, any picks here, Siddharth, before we go into close? Would you continue with the optimism on banks? Would you look at IT closely because we're going into result season and the big ones will start reporting in a couple of days?
Two stocks particularly looking interesting in this fall. One is State Bank of India. Pretty strong commentary after the Q3 numbers. I think stock had seen a good rally, but then take a beating because of the overall market correction. I think at current levels looks pretty interesting. Q4 should be pretty strong. We have a buy rating and a target price of around 1300. The other is from the NBFCs, Shriram Finance also. Looks pretty interesting, pretty strong earnings delivery consistently quarter after quarter. Q4 also should be pretty strong. And that is another stock that one can look at picking up in this fall. Again, we have a positive view on the entire earnings growth recovery for both banks as well as NBFCs. So these are the two picks from my side.
Okay. Let me also ask you, Siddharth, about Larsen & Toubro, because it is one of the top gainers on the Nifty 50 today, up as much as 3%. And I think a lot of people, brokerage houses is what I'm talking about, analysts are looking at this very closely to say that valuations-wise, it continues to remain attractive. Do you agree?
Yeah, Alex, I think there are definitely a lot of businesses. So we also had a look after this war came out, saying that there are a lot of moving parts that one needs to consider. But definitely they are benefiting a lot because of the EPC business that being pretty strong both in India as well as in the West Asian Gulf countries, which definitely took a beating in the current time. But valuations too became too attractive. So what we believe is that the international revenue, which accounts for about 39-40% of its order book, plus the IT business subsidiary, which is getting impacted because of AI-led disruption, both are mostly factored in the current valuations. And we see that while the near-term execution could get impacted, we believe long-term opportunities definitely is there, and hence we see that for our long-term investors, this looks like an interesting stock at a good valuation. We do have a positive view and a buy rating and a target price of about 4,400.
All right, Nagaraj, I want to come to you very quickly on some of these IT names, right? Which is that they moved quite considerably last week and they were outperforming the benchmark. Would you pick any of these as a trade?
Yeah, right. Right now, the IT sector has bounced back very well from the lower levels, still looking attractive. I think the worst period seems to be over for the IT stocks, and some of the prominent mid-cap IT stocks are in a bull run right now, at least for the short term.
Got it. All right. All right. On that note, gentlemen, thanks so much for taking the time and for speaking to us on NDTV Profit. Pleasure having you. Let's talk about the close today. And it turned out to be an entirely different day from what we were imagining it would be at the start.
Yeah, I think part of the reason, and we spoke about this on opening as well, Alex, is the fact that there seems to be no real red lines. The US president has given a series of deadlines and then has moved each of them ahead. And the latest one this morning was, of course, moving the 48-hour deadline from 6th of April to 7th of April, 8 p.m., I suppose, EST. So that fear is kind of receding. Talks of some formula for a ceasefire coming in. We don't know if it's true or not, but the market seems to believe it. Look, this is amazing. The intraday of the Nifty will tell you the story. So will the advanced decline line graph tell you the story very clearly. You're very close. Yeah, this is the high point of the day. And this gap widening. I mean, the bulls are coming back where there is opportunity. Probably DII inflows. I doubt FIIs are coming in thus far, but we'll have to wait and see what that data is showing. The Nifty heat map will show you Trent possibly on top. Even now, I mean, that spectacular move up, 8% up. But, you know, it was being pointed out how Trent is more than 50% off its highs. That stock price has seen such huge value erosion that this is like a little band-aid for investors who bought at 8,000 plus.
But you know what? We're at 22,970 or thereabouts. We would have been above 23,000 comfortably and closer to 23,050 if it wasn't for that.
For RIL and ONGC. Yeah. You're seeing both ONGC and RIL coming in and seeing a bit of pain over there. So is Max Health. Actually, nothing else moving.
60 odd points. Individually.
So, pulling down the Nifty that much. Nifty contributors will actually show you that figure more closely about how much is being pulled down. Yeah, nearly 70 points out of 80 is contributed by RIL. HDFC Bank coming back strong. Axis, ICICI Bank. This is actually truly heartening because the updates are showing that there is some health over there, and we spoke to CSB today. So banks have also been wise in making sure that they're well entrenched and safe from any bad news.
You know, I think there's also a nudge from the regulator. And we've been talking about this for some time, but we don't know necessarily all of the conversations that happen behind the scenes. The regulator is well seized of the fact that gold loans have been rising as much as they have. So, but have a look at the sectoral picture as well. You will see oil and gas at the bottom of the screen on account of Reliance Industries. That remains the one spot of red on an otherwise very pretty screen. Look up here and you will see PSU banks, and up there you will see the banking index doing particularly well in trade today, and even the IT index has moved off the low point of the day to trade with gains of as much as 0.7%.
Yeah, so business updates is going to continue to rule the roost going into trade tomorrow as well. Of course, the big geopolitical issue continues. Let's look at that closing tick coming in this Monday morning. A very different picture on the screen compared to how we started off. We should pull up the Nifty for this, please, and look at the mid cap and the small cap as well. We're ending 244 points in the green, well above the 22,900 mark. The Nifty mid-cap 150, about 1.5% up. The advanced decline ratio looking very robust, 1:5, 1:4 actually. Nifty small cap 250 also 1% up as we close off. So what's going to happen in the next 12 hours or so? You're going to hear from the US president. You might get some clarity on a claim or an actual ceasefire. If a ceasefire of any sort, form or shape can be announced, that'll be a huge continuation of what you're seeing in markets right now. On top of that, I think business updates are something that you need to keep an eye out on very closely. At the end of the day, it's real companies putting out real performances. And then, of course, we get into result season.
Yeah, absolutely. Monetary policy and then result season. So, well, lots to look forward to, and we'll talk about a lot more of this over the course of the day. So I'd encourage you to stay tuned. From Tamanna and myself and the team that put this show together, thank you so much for watching, and do stay tuned. This is NDTV Profit.
केसरिया से मन जोगी हुआ रे दिल झूमे देखो मतवारा हुआ रे केसरिया से मन जोगी हुआ
हर पल मनाओ केसरी त्योहार विमल बोलो जुबान केसरी.
Hi, I'm Tamanna Inamdar. Watch me on NDTV Profit, where I break down the day's biggest business stories. What happened, why it matters, and what it means for your money.
Hi, I'm Neeraj Shah. Watch me on NDTV Profit for the most incisive market intelligence and meaningful corporate conversations.
And I'm Alex Matthew. Markets, mutual funds, insurance, personal finance. I help you cut through the noise and make smarter financial choices. And here's where you can watch us.
Presenting the all-knowing, all-powerful Tech Guru.
Whoa. Guru? I'm no guru.
Okay.
I'm just a guy who loves his tech.
A show where the mysteries of megabytes and motherboards shall be unraveled.
Bro, nobody talks like that anymore. This is all about connected ecosystems, EVs and AI that you can use in your daily life. That's what we do on Tech 360. Real talk, real reviews, tech that you can actually use.
Tech has changed. So should your tech show.
To understand the Tamil Nadu twist, join me in the midst of our people, language and politics. Vanakkam Tamil Nadu, here we come.
The stories that matter.
Hello and welcome viewers. You're watching Market Express and I'm Himakshi Bahugna. Let's get straight into the show and see how the markets have really fared today. So markets have reversed the early losses to end the day near day's high. Both the Nifty and Sensex have ended 1% higher. Trent and Axis Bank have lent support and also surges in trade on the back of strong Q4 business updates. Now RIL ends as one of the top Nifty 50 losers. And talking about the sectors, so most of the sectors have ended the day in green, with PSU Banks Realty leading the gains. And oil and gas on the flip side held on to a tinge of red. Now let's look at some key stocks that were buzzing away in trade today. First up, we have Trent that has wrapped up the March quarter with a solid, showing, delivering a 20% revenue growth, which is an improvement over the previous 2 quarters. And also the store expansion continues at a healthy pace, and this has been led by aggressive additions in the Zudio and also steady scaling at Westside as well. So while the average revenue per square foot has softened slightly, management remains confident about the company, also maintaining 20 to 25% of growth guidance as demand traction is expected to improve over the medium term. And with also valuations now below historical averages, the spotlight shifts to execution, store productivity and also earnings delivery in the coming quarters. And here's Nykaa has delivered yet another standout quarter, marking its strongest growth in the last 12 quarters. So the momentum has remained broad-based, with consolidated GMV growth tracking in the late 20s, while the net sales also value growth that ran even stronger for the company. And the beauty business, if we look at, has continued to fire on all the cylinders, supported by the company's highest ever quarterly store additions, while fashion has seen accelerating revenue traction with the NSV growth clearly outpacing the GMV. And importantly, management has flagged no impact from the Middle East exposure so far, keeping the near-term risks contained as Nykaa sustained its growth trajectory. And next counter in focus is Wipro, that has landed a rare big ticket win. Now the IT major has secured a $1 billion transformation mandate from the Olim Group, which is spread over 8 years and also offering long-term revenue visibility at a time when large deals are hard to come by. And the engagement will be delivered through a consulting-led AI-powered approach, also signaling Wipro's push towards higher value transformation work. Crucially, the deal also includes the acquisition of Olam's IT arm, Mindsprint, giving Wipro a deeper domain expertise in the food and also agribusiness space. So along with an embedded client platform as well. Next counter in focus is Pace Digitech, which is seeing strong order momentum pick up pace. So the company has received a large letter of acceptance from NTPC for a battery energy storage system at the Nabi Nagar power station, also reinforcing its positioning in the fast-growing energy storage space. So this adds to a string of recent wins across railways and also grid-scale storage projects. And this is also pushing the order book to over 8,000 crore rupees, with visibility improving and also a clear push towards clean energy infrastructure. Pace Digitech is now eyeing a further scale-up in orders by the end of this financial year. And viewers, next counter in focus is Vikran Engineering, which has received a fresh order boost from the Maharashtra government, also securing 2 projects worth over 530 crores across the Nashik and Kolhapur zones. The projects are spread across multiple locations and also are expected to be executed over the next 21 months. So the twin wins enhance the revenue visibility and also reinforce Vikran's presence in the state. So level infrastructure execution with a healthy project pipeline and also steady inflows. Focus now shifts to timely execution and also margin discipline as the company works through its expanding order book. Next counter in focus is Tata Motors passenger vehicle. So its passenger vehicle business is back in focus after a weak operational update from the JLR and also mixed volume trends in the March quarter. While the wholesale volumes have rebounded sharply after the cybersecurity disruption, retail sales continue to see year-on-year growth, degrowth, and also pointing to demand pressure. So geographically, if we look at, volumes remain lower across the most of the markets, with Europe, which is a lone bright spot there. Looking ahead, FY26 volumes are expected to stay under pressure, and this is weighed down by the US tariff impacts and also challenges in the China market. The planned wind down of the legacy Jaguar models ahead of the new launch, and also production stoppages linked to the cyber incident. And if we also look at the execution and recovery, so that will also remain key themes going forward. And here's TVS Motor is firmly in focus after Goldman Sachs has upgraded the stock to buy, citing improving fundamentals and also stronger earnings visibility. Now, the brokerage has raised its target price, pointing to TVS's, as compared with peers. So Goldman has also highlighted superior volume visibility, and this is driven by upcoming premium launches, and also expects TVS to pass through the cost pressures more effectively. And adding to that, a margin tailwind from the PLI scheme, and also the brokerage is seeing TVS better positioned to navigate the commodity volatility and also sustain the profitability. Whereas Nuvama Institutional Equities has also maintained its buy rating on Sobha, even as it cuts the target price, and also citing a more cautious near-term macro backdrop. Now, the brokerage highlights healthy pre-sales and also a sharp surge in launches in Q4 of FY26, with Bengaluru expected to continue driving volume growth. However, Nuvama has flagged rising risk perception for the real estate sector, and this is also pointing to concerns around the potential job losses from AI disruption, along with uncertainty linked to the ongoing global conflict, which has weighed on the housing demand across markets. Now, the call reflects confidence in execution, and this has been tempered by the macro risks. Next counter in focus is Aurobindo Pharma. It has announced an 800 crore shares buyback and also signaling a return of capital to shareholders. So the company will buy back shares of 1,475 rupees a piece through tender offer route, with program open to all the shareholders, including the promoters. Now, the buyback involves just over 54 lakh shares, also representing less than 1% of the total equity, with the record date fixed for April 17, 2026. Now, from a balance sheet perspective, the buyback amounts to around 3.9% of the standalone net worth and also about 2.6% of the consolidated net worth. Now, keeping the financial impact manageable while also enhancing the shareholder returns. And PVC players are back in focus after a sharp price cut of around 10 per kilo, raising concerns over demand and also profitability. Now, Nuvama has flagged that this move as a potential trend reversal, pointing to weak agri demand and also heavy channel inventory, and also rising pressure from cheaper Chinese imports. Now, the brokerage has also seen April demand remaining soft, which could weigh on the volumes and also margins in the near term, with price-led volume recovery coming at the cost of realizations. Q1 of FY27 risks are building, especially for players like Astral and Supreme Industries, where EBIT sensitivity to PVC pricing remains very high. And whereas Senco Gold has posted strong growth in the March quarter, riding higher gold prices and also steady wedding demand. So revenue has risen sharply, and this has been helped by solid same-store growth, even as volumes stay muted due to elevated gold prices, and the company expands its showroom network, protects the margins through tight inventory control, and also leans into affordable lightweight jewelry. Now, looking ahead, Senco targets healthy value growth, stable margins, and also a strong store expansion pipeline in the new financial year. Next counter in focus is Reliance Industries. It has come under sharp pressure, slipping to a 10-month low as selling intensifies on the street. Now, the stock weighs on the benchmark, with concerns rising around the impact of the US-Iran war on its energy business. Now, higher freight and insurance cost, muted growth in telecom, and weak gas output add to the drag, even as retail offers some sort of support. Now, markets now watch how the conglomerate, really navigates this volatility across its key segments. And here's beverage prices. could be headed higher as cost pressures intensify across the industry. Companies like United Spirits, United Breweries, Radico Khaitan, Allied Blenders and also Varun Beverages are facing sharp increases in packaging and logistic costs. So while alcohol makers need state approvals to raise the prices, non-alcoholic players have more flexibility to really pass on the costs. And NMDC hikes iron ore prices again, marking its third increase this year. This move is driven by higher global prices amid Middle East tensions, which is firm domestic steel demand and also strong restocking by mills. Now, the price hike is expected to support the NMDC's margins with, the miner already reporting strong production and also sales momentum. Now, markets are now watching how steel makers really absorb the higher input costs. And now let's look at some brokerage notes. Morgan Stanley says that seaborne iron ore prices stay elevated for now, but warns that higher shipments and also China's steel supply reforms could really turn the sentiment, negative ahead. And also the brokerage has flagged near-term pressure for the steel makers like JSW Steel and also JSPL due to their external iron ore dependence. And India's auto dealers strike a cautiously positive note even as near-term risks remain in focus. FADA has said that March sales stay strong across segments held by healthy demand and also improved availability. Looking ahead, dealers expect growth to continue over the next few months, though concerns around West Asia led supply disruptions, fuel prices and also seasonal slowdown do persist, and the industry remains optimistic on the full year outlook while keeping a close watch on the emerging headwinds as well. And the government is considering shelving the current bids for the privatization of the IDBI Bank and also may call for fresh bids due to low valuations received. So a high-level meeting chaired by the Cabinet Secretary is underway to decide the next course of action. And this is the second such meeting in a week involving senior officials from DIPAM and also, the Department of Financial Services. Now, the existing bids are reported to be well below the government's minimum reserve price, with two potential bidders quoting valuations in the range of 40,000 to 45,000 crores. And also restarting the process with fresh bidding would take additional time, as it would begin, from the scratch. So a final decision is expected soon after the ongoing deliberations. And as Amul has become the first Indian FMCG company to cross 1 lakh crores in annual turnover. Yes, so the Gujarat Cooperative Milk Marketing Federation, which markets the Amul brand, has achieved this milestone in the financial year 2025-26. Now, this makes Amul the largest Indian FMCG company by turnover, surpassing many established multinational and also domestic players. Now, the achievement is driven by strong growth in dairy products, ice cream, and also value-added items across both domestic and international markets. And the Supreme Court has refused to stay the takeover of Jayaprakash Associates Limited by the Adani Group, and the court has asked Vedanta, which had challenged the resolution plan, to contest the matter before the National Company Law Appellate Tribunal, that is the NCLAT, and a bench declined to intervene at this stage and also said that the issues raised by Vedanta should be decided by the NCLAT, and this paves the way for the Adani Group to proceed with the acquisition of the debt-ridden infrastructure company. And the development is a major setback for Vedanta, which had approached the Apex Court seeking an interim stay on the approval granted by the NCLT. Next counter in focus is Nykaa, which is in advanced talk to acquire a majority stake in 82E, the skincare brand co-founded by actress Deepika Padukone. Now, the deal, if finalized, would mark Nykaa's entry into the fast-growing prestige beauty segment and also give its, control over one of the most prominent Indian celebrity-backed brands. So 82E, which focuses on clean and also science-based, skincare, has seen some strong growth since its launch, but has reportedly been, struggling with scaling and profitability. So for Nykaa, the acquisition would help expand its own brands portfolio and also strengthen its position in the premium skincare category. And Saudi Arabia has raised the price of its flagship crude sold to Asia to a record premium as the near closure of the Strait of Hormuz continues to disrupt the regional energy flows. Now, state oil giant Saudi Aramco has lifted the Arab Light prices for May sales to their highest ever level. And this is reflecting acute supply stress across the Persian Gulf. Now, the move comes even as the hike fell short of market expectations, also underlining extreme volatility as the Iran conflict drags on. With the Hormuz largely shut and also global fuel prices surging, the energy shock is rippling across the markets, also pushing the crude sharply higher and intensifying inflationary pressures worldwide. And here's OpenAI is facing internal differences over the timing of its much-awaited initial public offering. Now, CEO Sam Altman is pushing for an early listing, also possibly as soon as late 2026, while the CFO Sarah Friar has cautioned that the company may not be ready by the fourth quarter of 2026. So he has highlighted that the need for more work on compliance, internal systems, and also managing high cash burn from massive spending on computing infrastructure. Also, reports suggest that the company could burn over $200 billion before turning cash flow positive, and also plans to spend more than $600 billion on cloud servers, in the next 5 years. OpenAI was recently valued at $852 billion after raising $122 billion. Now let's look at some national news, viewers. Prime Minister Narendra Modi has said that despite the ongoing war in the Middle East causing global outrage, the BJP NDA government is continuously working for the welfare of the Indians. Addressing a public rally in Hojai, Assam, Modi has assured that the burden of the global crisis will not fall on the poor, the middle class, or the farmers, and he's highlighted that the government has taken steps to shield the citizens from the impact of rising global prices and also supply disruptions. And the Indian-flagged LPG vessel Green Asha has successfully crossed the Strait of Hormuz today. Now, this marks the 8th India-flagged LPG carrier to navigate the critical waterway since February 28th amid the ongoing Iran-Israel conflict, and the crossing comes despite a maritime blockade imposed due to the war. Another vessel, Green Sanvi, has also crossed on Friday night carrying 46,650 metric tons of the LPG. Now, the Indian government has been in continuous talks with Iranian authorities to ensure safe passage, and the Indian Navy has kept warships on standby to support merchant vessels. As of now, all the Indian seafarers in the region are reported safe, with over 964 already repatriated. And the Delhi government has launched a major crackdown on black marketing of LPG cylinders. Now, Chief Minister Rekha Gupta has announced a complete ban on direct sales of LPG from storage godowns. All the cylinders must now be delivered only through authorized home delivery by distributors. So this move aims to improve transparency and also prevent hoarding amid concerns over supply disruptions due to the West Asia conflict. And Delhi police has conducted raids at 17 locations, while the Food and Supplies Department has inspected 76 gas agencies. Now, a dedicated control room and helplines have been set up for monitoring and also complaints. And the government has also increased availability of 5 kg of cylinders for much easier access, especially for the migrant workers. And Iranian Foreign Minister Abbas Araghchi has spoken with the External Affairs Minister S. Jaishankar yesterday to discuss the ongoing Middle East conflict and also its impact on the regional stability. So the call comes amid heightened tensions. Jaishankar has also held a separate conversation with the foreign ministers of Qatar and the UAE on the evolving situation. So India, which sources a significant portion of this energy from the Gulf region, is closely monitoring the developments as the conflict, really disrupts the global energy supplies and also shipping through the critical waterways. And the discussions focus on bilateral relations and also ways to ensure stability in the region. And Indian High Commissioner to Bangladesh, Pranay Verma, has met Bangladesh Prime Minister in Dhaka today. The meeting was a courtesy call focused on strengthening the bilateral ties and also people-centric cooperation in areas aligned with both the countries' development priorities. And, he's conveyed India's positive and forward-looking approach based on mutual interest and also benefit. And this engagement comes as the two neighbors work to reset the relations after a period of strain following the change of government in Bangladesh. Now, Bangladesh's foreign minister is scheduled to visit India later this week for high-level talks with key Indian ministers. And the Delhi government has announced a 22,236 crores of green budget for 2026-27 as part of its overall 1,03,700 crores of state budget. Now, over 21% of the total budget is dedicated to cleaning the Yamuna River and also reducing the air pollution. The largest allocation of 6,485 crores goes to the Delhi Jal Board for sewage treatment and also cleaning major drains that really pollute the Yamuna. And another 4,758 crores has been set aside to expand the electric bus fleet and also strengthen public transport, while 3,350 crores will be used for dust control and also green infrastructure projects. And 17 departments will track their spending against green objectives, and also a dedicated green fund has been created for accountability. And here's a draft proposal for a 45-day ceasefire and reopening of the Strait of Hormuz has been received by both Iran and the United States. And the proposal, mediated by Egypt, Pakistan, Turkey, aims to provide a window for extensive negotiations towards a permanent ceasefire. And it was delivered late last night, but neither side has responded yet. And Iran has insisted on financial reparations and also a guarantee of no future attacks as part of any agreement. So the development comes as the conflict enters its second month with continued US and Israeli strikes on Iranian targets and also Iranian retaliatory actions. So in the latest updates, Iran has confirmed the death of IRGC intelligence chief Majid Khademi. And also reports indicate, and he was killed in a strike linked to the ongoing US-Israel conflict, dealing a major blow to Iran's security leadership. So the development is expected to fuel further escalation, with Tehran warning of strong retaliation. And because Iran has rejected a proposal for a temporary ceasefire aimed at reopening the Strait of Hormuz, a senior Iranian official has stated that Tehran will not accept a short-term truce in exchange for reopening the critical waterway. And this comes as US President Donald Trump has extended his deadline for Iran to open the strait, to 8 p.m. Eastern Time on Tuesday, warning of severe consequences if it remains closed. And Nepal has shifted to a 5-day work week, designating both Saturday and Sunday as weekly holidays as it grapples with a fuel crisis triggered by escalating tensions in the Middle East. Now, the decision was taken at an emergency cabinet meeting, with the government saying that the move is aimed at, conserving fuel and easing supply pressure. Government offices and educational institutions will now operate Monday to Friday, which is a major shift for Nepal, where Saturday had traditionally been the only weekly holiday. Authorities say that the step comes as fuel shortages and rising prices strain the economy. And with that, viewers, it's a wrap on this edition of Market Express. Stay tuned to NDTV Profit for more news and updates.
केसरिया से मन जोगी हुआ रे दिल झूमे देखो मतवारा हुआ रे केसरिया से मन जोगी हुआ
हर पल मनाओ केसरी त्योहार विमल बोलो जुबान केसरी.
Hi, I'm Tamanna Inamdar. Watch me on NDTV Profit, where I break down the day's biggest business stories. What happened, why it matters, and what it means for your money.
Hi, I'm Neeraj Shah. Watch me on NDTV Profit for the most incisive market intelligence and meaningful corporate conversations.
And I'm Alex Matthew. Markets, mutual funds, insurance, personal finance. I help you cut through the noise and make smarter financial choices. And here's where you can watch us.
Presenting the all-knowing, all-powerful Tech Guru.
Whoa. Guru? I'm no guru.
Okay.
I'm just a guy who loves his tech.
A show where the mysteries of megabytes and motherboards shall be unraveled.
Bro, nobody talks like that anymore. This is all about connected ecosystems, EVs and AI that you can use in your daily life. That's what we do on Tech 360. Real talk, real reviews, tech that you can actually use.
Tech has changed. So should your tech show.
To understand the Tamil Nadu twist, join me in the midst of our people, language and politics. Vanakkam Tamil Nadu, here we come.
When others are warming up, I'm raring to go.
Welcome to Watching Prime 5 with me, Raisha Saigal. What's happening? How?
The show that sets the prime time agenda.
We'll be deep diving into this topic to tell you what's at stake.
Join me, Raisha.
Market gains smartly on hopes of a US-Iran deal. Nifty reclaims 23,900 levels. Sensex gains over 1%. RIL remains a big drag due to selling pressure, ending with a loss of more than 3% on the counter. According to reports, Pakistan pushes for two-phase Islamabad accord to end US-Iran war. Reopen Strait of Hormuz. All eyes are on Trump's address tonight at 10:30 p.m. India time. Oil prices slide after US President Donald Trump's ultimatum to reopen Strait of Hormuz by Tuesday. The US WTI crude is hovering around $109 per barrel. Brent is trading in the red too, close to $108 mark. Two more LPG tankers transit from Strait of Hormuz successfully. 8th India-flagged LPG vessel to transit since the war began. Government confirms 16 Indian-flagged vessels in the Hormuz awaits clearance. Supreme Court refuses to stay Adani Enterprises resolution plan for Jaiprakash Associates, urges NCLAT to hear Vedanta's plea on priority, which challenges Adani win under the IBC process. Sources tell NDTV Profit that government may opt for fresh bids for IDBI Bank. Cabinet Secretary holds second meeting with Deepam and DFS. Two potential bidders are already in the fray. Beauty platform Nykaa is set to acquire its brand ambassador Deepika Padukone's skincare label 82 Degree East, sources tell NDTV Profit. Hello and welcome. You've tuned into Profit 360. I'm Nisha Poddar. Let's first begin with the market as a top story. Well, the stock market recovered strongly from the morning losses to end in the green today. And the Nifty as well as Sensex both wrapped trading around 1% higher today. While the Nifty, remember, surged past 22,950, the Sensex crossed 74,000 level. Bank Nifty also ended with gains of over 2%. So a stable start to the week. But let's also get you the entire market action with Jasmeet, my colleague, who's joining in with all the market-specific details. Jasmeet.
Well, positive up moves seen for the market. Nifty ends in green for third consecutive day in a row, while Nifty gains about 800 points from the lows of the Friday as we had seen. Nifty advanced decline ratio stands at 43:7 today in trade. While Trent was a top gainer in Nifty in today's trade, up about 7.5%, followed by Adani Enterprise up about 3.5%. If we look at the broader market, we do see that the broader market have gained in line with the benchmark in today's trade, while Midcap 150 is up about 1.5% and ends in green. The top gainer in Nifty Midcap 150 were Kalyan Jewellers and L&T Finance, both gained over 5%. Now in terms of the small cap 250, even that gains in trade, ends in green up 1%. Now top gainer in small cap 250, we have stocks like Graphite and PTC, both gaining up over 6% in today's trade. If we look at the key sectors, all sectors end in green, barring Nifty Oil and Gas. The Nifty Oil and Gas sees the continued pressure of the global geopolitical tension. Now in terms of the key sector and the movements, Nifty Financial Services, Nifty PSU Bank are the top gaining sector in today's trade. While in terms of what led the gain was BSE and Shriram Finance, the top gainers in Nifty Financial Services, both up about 4%. In terms of PSU Bank, we have Bank of Maharashtra and Bank of Baroda, the top gainers in Nifty PSU sector as well, and both gained about 4%. If we look at Nifty Oil and Gas, the top losing sector, which ends in green, down about 1% in today's trade. The top losers, Chennai Petro and Reliance, the both lose about 3.5% in today's trade. If we look at the other key factors and how the trends have moved in today in market, we do see Nifty Financial Services, Nifty Realty, Nifty Bank, Nifty Metal, Nifty IT, Nifty FMCG end in green for third day in a row, while Nifty Pharma snaps its 4-day of losing streak and ends in green today. While lastly, Nifty Oil and Gas end in red for the second day in a row.
All right, thank you so much, Jasmeet, for getting us all the details of the market action. And yes, it recovered after there were some hopes of some de-escalation of war and a deal between US and Iran. Now, in light of the Middle East war, remember Vinod Karki, who's the head of strategy at ICICI Securities, he predicts that oil prices will remain above $100 per barrel for at least 2 to 3 months. Listen in.
I think from a base case perspective, we are almost 1 month past this crisis which started. It appears to be a case where this will be a 2-3 month affair where oil prices can remain above this $100 level for maybe a quarter, 2-3 months, which effectively, I think the market has taken due cognizance of that. If you see from the point where the conflict started, the market cap erosion has been close to 50 trillion rupees, which is almost 13-14% of GDP. So the market, I think, is kind of pricing in.
All right. In particular, let's talk about one particular heavyweight in the market, Reliance Industries. That hit a 10-month low in the trading session today. It dropped over 4% intraday and recovered a slight bit. Despite the market recovery, RIL stock still left the day with over 3% loss. So let's find out from my colleague Somit on what really is putting pressure on Reliance Industries stock. Somit.
Reliance Industries remains in focus, and that is one of the biggest culprits when it comes to the benchmark index. Though Nifty 50 is up over 200 points in trade, Reliance Industries is one counter which is holding it back. It is dragging the benchmark by at least 70 odd points in trade. On a YTD basis, if you look at the stock is down nearly 17%, which is the worst start for Reliance Industries to the year that we have seen at least since 1997. To give in context, Nifty 50 is down around 13% on a YTD basis. Now, what could have led to this 4% downtick in the share price of Reliance Industries in trade today? Firstly, it could be the weak performance of the O2C segment in the fourth quarter. Now, Middle East war could have impacted the performance because of which there was multiple disruptions that we had seen. There was a lot of price volatility, crude deliveries were disrupted, freight and insurance costs were also higher. Apart from that, the marketing segment of the company would have also incurred some losses given the fact that retail fuel prices continue to remain unchanged while crude prices were on an uptrend. Apart from that, when you look at the telecom segment, the performance of the telecom segment could also be impacted given the fact that there was no tariff hike that we have seen for at least the last 6 months, and subscriber addition of late has also been muted for Reliance Industries in the fourth quarter so far. And when it comes to gas exploration segment, that segment could report a weak set of numbers. In fact, we could see a sequential decline on the EBITDA front when it comes to the gas exploration segment, largely because of lower production and higher cost. And the only savior could be the retail segment, and that too also because the peers have reported a strong growth in the fourth quarter. Peers like Trent, Avenue Supermarts, Senco, Nykaa have reported strong growth on a YOY basis for Reliance for their fourth quarter numbers. So that is at least indicating that the retail segment could report a good set of numbers. Even if the retail segment reports muted numbers, then overall Reliance Industries numbers could be on the weaker side, and that could be one of the reasons why the stock is down in trade. Now, if you look at the valuations, the 12-month forward valuation stands at around 20x, while the 5-year average is largely at around 21x. So, not much of at a discount compared to its 5-year average valuation. And when you look at the analyst view, analysts continue to remain quite bullish. In fact, Reliance Industries share prices are trading below compared to the lowest target price on the street that is there for the counter. If you look at the 12-month consensus target price, that stands at close to 1,718, which suggests an upside of around 33%. The lowest target price is close to 1,385, which suggests an upside of close to 7%. And the highest target price on the street stands at close to 1,910, which suggests an upside of nearly 47% on Reliance Industries.
All right, thanks so much for Somit for getting us all those details on Reliance Industries, a big heavyweight and the key dragger today on Nifty 50, but it could be also because of trade-off as it's a heavyweight and with sector and stock rotation, especially from the foreign institutional investors. All right, let's focus on crude oil, and oil prices tanked a bit after US President Donald Trump, in a stern warning, signaled to open Hormuz by Tuesday. While the US WTI crude is hovering around $109 per barrel, well, Brent is trading in the red too, close to about $108 mark. Meanwhile, remember, the 8 members of the OPEC Plus have agreed to increase the production by 206,000 barrels per day in the month of May. But it is unclear how the oil will really reach the global market with the strait still closed. So definitely some news of US-Iran deal is softening the crude oil prices. Now, overseas travel is set to get costlier for the Indian flyers as airfares on India-US and India-Europe routes, including key destinations like New York, Newark, Chicago, London, Frankfurt, are all up anywhere between 50 and 150%. Yes, you heard it right, 50 to 150%. What led to this particular spike? My colleague Danish shares all the details. Tell us, Danish.
Well, if you're planning to catch a flight to North America or Europe from India, then be ready to burn your pockets as a spot airfare between popular city pairs between India and North America and India and Europe has surged by more than 100% over the past few days. One of the major reasons why this is happening is the fact that the key airspace over the Middle East still remains to be shut, because of which flights are being diverted in a longer route, which results in high fuel uplift for airlines, resulting in higher ticket prices for the passengers. The second fact is the high ATF prices over $100 a barrel, and the ATF crack is also over $150. So hence we are seeing this issue in the ATF prices. But if we now talk about some popular destinations, for example, if you want to catch a flight to Delhi to New York for Tuesday, then you have to pay between 1.40 to 2.20 lakh rupees, and on a normal day you were supposed to pay somewhere between 80 to 90,000 rupees. Similarly, if you look at other city pairs, for example, Mumbai, Newark or Bengaluru to San Francisco, over here we are seeing that the airfare has surged by over 100%. And now if we talk about certain European routes, for example, Delhi to London or Delhi to Paris, earlier you were supposed to pay somewhere between 35,000 to 50,000 rupees on a higher side for a spot ticket, but now this price has surged to over 70,000 rupees, also reaching to 1.20 lakh rupees per, according to different airlines. And one of the reasons why this is also happening is the fact that over the past few days, the central government tried to intervene intervene for the ATF, and while for the domestic airlines there has been a cap, but for the international airlines or for the international flights there is no cap, as now ATF for international flight operations is now over $1,000 per kiloliter, and hence the sharp surges being seen. So all in all, if we see, if you're planning to fly to any international destination, especially to North America or Europe, be ready to shell out more money from your pockets.
Of course, summer vacations are just around the corner and international vacation looks much more expensive. Thanks so much, Danish, for all those details. Meanwhile, India has rescued 2 more LPG tankers from the Strait of Hormuz. In fact, Indian-flagged liquefied petroleum gas or LPG tankers, both Green Asha as well as Green Sanvi, have successfully transited the Gulf carrying the fuel for the Southern Asian nation. Now this marks, remember, the 8th India-flagged LPG vessel to really transit the strait since 28th of February when this war broke out. In fact, 16 Indian-flagged vessels in the Hormuz awaits clearances so far, and Prime Minister Modi ensured that the government won't let the burden of the global crisis really fall on the citizens. Listen.
आप देख रहे हैं कि दुनिया में कितना बड़ा संकट आया है। पश्चिमी एशिया में चल रहे युद्ध से दुनिया भर में हाहाकार मचा हुआ है। अमीर से अमीर देशों में भी इस समय स्थितियां बहुत खराब है। जो छोटे और विकासशील देश हैं, उनकी हालत भी बहुत खराब है। लेकिन साथियों, संकट के इस समय में भी बीजेपी सरकार देशवासियों के हित में लगातार काम कर रही है। बीजेपी एनडीए सरकार ने ये सुनिश्चित किया है कि वैश्विक संकट का बोझ गरीब पर, मिडिल क्लास पर, हमारे किसानों पर न पड़े।
Now, amid the ongoing tensions in the Middle East, well, the government ensures that the country is not facing any pricing fluctuations in the commodities sector. Let's listen in to what Anupam Mishra, the Additional Secretary, Department of Consumer Affairs, said today.
What we have seen so far, there has been no unusual volatility in the prices of the essential commodities, number one. Number two, if we come on the supply side, so what we see that pulses. Now the production of pulses this year is higher than what we had in the previous year. So what we mean by pulses, those 5 major pulses, tur, urad, masoor, chana, and then urad. So they basically comprise of a pulses basket. Second, you'll be aware that government maintains a buffer of pulses. Now this buffer is maintained basically if you need any market intervention, you have these pulses which you can release in the retail market. So the present stock of buffer that we have of pulses is 28 lakh metric ton. Procurement of tur and rabi pulses under the PSS, public support system, is under progress.
All right, government saying that we are prepared and assures the citizens. Now let's get you the latest coming in from the Middle East war. Well, according to reports, in a last-ditch effort to avoid a major escalation, Pakistan is pushing for a 2-phase proposal for the end of the US-Iran war amid the fresh warnings and threats from US President Donald Trump. In fact, reports do suggest that US, Iran, and a group of regional mediators are engaged in discussion over a proposed 45-day ceasefire, and all eyes are now on Washington, D.C., with Trump expected to really deliver a key address later tonight. Meanwhile, Iran has clearly rejected any move to reopen a key global oil route in exchange for a temporary ceasefire. In fact, Israel says that it has killed a top intelligence chief of Iran's Revolutionary Guard, while missile and drone attacks really continue across the region, hitting key locations in Israel and even in the UAE. So that development is really taking place, and as the Middle East conflict really continues to disrupt the global supply chain and keep the energy prices elevated, well, the government is stepping up its preparedness on the domestic front as well. Sources tell NDTV Profit that a high-level meeting was held last week to boost production of key items like induction cookers and petrochemicals. Let's take it across to my colleague Rishabh for more details on what was discussed at the meeting and what it means for the industry as well as the consumers. Rishabh, tell us.
Absolutely. What you had is, like you said, a preparation on all fronts. And one of those preps involves sort of amping up the domestic production of key products like induction cookers as well as critical petrochemicals. So what the government's POV is, it is to sort of look ahead, even if the war continues for a few months, starting now, the availability as well as the affordability of critical supplies like induction cookers should not stop. So in that vein, there was a meeting that was held between DPIIT, DGFT, various other ministries had representation as well. And what they decided was on that there will be some sort of a boost in production, and various ways to boost that production were also discussed. What we've also already seen from the government is a cut on import duties on various petrochemical products that are critical to other, that are actually critical raw materials to other products. So that's what we're seeing from the government, is this sort of proactive approach wherein more and more interesting and more important products are being sort of lined up, even at the sort of taking care of the worst case scenarios that are also coming up if the war continues.
All right, thanks so much, Rishabh, for all those details. Now, in an exclusive update, our sources tell us that the government may really opt for fresh bids for IDBI Bank's stake sale. Now, a meeting chaired by the Cabinet Secretary was in fact held today, and this is the second such high-level meeting in a week with officials from both DIPAM, DFS and other departments also involved in that. Sources say that the bids received from the bank were much lower than the government's minimum reserve price. In fact, two potential buyers had quoted a valuation of 40,000 to 45,000 crore rupees. Now, the government may decide to shelve the current bids and also start afresh, and a fresh bidding process can really start. However, a new process will take time as it has to begin from scratch. Now, the final decision is expected soon, so that really is something to watch out for IDBI Bank. Now, as business updates really start trickling in, Piyush is here, my colleague, who tells us more about how the key banks really performed this particular quarter. Before we get you the word from the managements that are going to come in and the numbers really trickle in, here's a business update coming in from Piyush on how the banks are really looking at the coming quarterly results. Piyush.
Banks have posted a strong set of numbers for Q4, which is technically the most busy season for banks. Leading banks have reported double-digit rise in both their loans and deposit book, although the pace of deposit growth remains to be slower than the pace of credit growth, which is also leading for banks' CD ratio to go up, and the RBI may not be very content with that ratio moving up. Bankers tell us that the retail, agriculture and MSME segment has really done well for PSU banks, whereas private lenders have seen a spurt in their gold loans, unsecured personal loans as well in Q4. Bankers say that MSMEs could see a hit if the Middle East conflict continues for a month or two more. In Q1, banks expect a slight uptick in stress in the SME segment. Number-wise, Axis Bank and Kotak Bank posted really strong set of loan growth numbers, whereas HDFC Bank's loans were up 12% and deposits were up 14% in line with the management commentary. Fitch Rating expects Indian banks' margin to fall by 20 to 30 bips in the next financial year, as they see limited flexibility for the RBI to put durable liquidity into the system after the recent efforts that they took in to defend the Indian rupee.
All right. Thanks, Piyush, for that. From banking, let's take it straight to pharma. And pharma sector is set to swallow a bitter pill as Trump really readies another tariff blow on them. Patented medicines will face 100% tariff entering the US. Varsha is here with all the details.
So 100% tariff has been imported on branded and patented drug, while generics are exempted when it comes to Trump tariffs, and biosimilars are also exempted from tariffs. Now, what's the reason for this? Of course, the focus is on national security and supply chain control, and Trump wants the push for domestic manufacturing in US, and the $400 billion investment commitment has already been driven, and API reserves and local production push is ongoing. How this is going to impact on global pharma, where big pharma will see pricing pressure, supply chain may shift to US manufacturing, and CDMO may face uncertainty because of this push. Now, impact on Indian generic pharma, no tariffs currently. Near term is positive when it comes to generic pharma. Hence, biosimilar is also fully exempted. But there will be a little impact on Sun Pharma, considering its high branded exposure of around 20%. Illumia, which comes under the specialty portfolio, will see 15% of tariff, and EBITDA impact is expected at 1 to 2%. Who can benefit though? The companies who have US manufacturing setup. You have Aurobindo Pharma, Alchem Lab, Jubilant Pharmova, Zydus Life Sciences, and Piramal Pharma, which will have benefit, or which will be gaining, considering their US manufacturing setup that they have.
All right. Thanks so much, Varsha, for getting us all those details now at a time when global markets are really grappling with supply shocks from the Middle East war. Well, SEBI chairman Tuhin Kanta Pandey, who has really flagged rising risks to the global economy, he also says that SEBI is working on a large-scale initiative to strengthen corporate governance through capacity building of independent directors. Let's listen in.
We are meeting at a tumultuous time, with war in West Asia choking oil and gas supplies, triggering global price shocks, with severe impact on world economy. SEBI will seek to embark on a joint initiative for capacity building of independent directors at scale, with a view to further improve corporate governance.
All right. In another important corporate development and an IBC-related case, it's a legal development that's really taken place. The Supreme Court has refused to intervene in Vedanta's plea seeking a stay on Adani Group's resolution plan for debt-laden company Jaiprakash Associates. And this is, remember, through insolvency and bankruptcy case in which a bid process was done, which has been challenged by Vedanta. In fact, the court declined to halt the implementation of the plan, but did urge the challenger Vedanta to really go to NCLAT, and has also said that NCLAT should give priority to this particular plea by Vedanta. So that's an important development. And when we talk about corporates, well, sources confirm that Nykaa is set to buy Deepika Padukone's skincare label, which is 82 Degree East. Now, remember that Deepika Padukone is Nykaa's global brand ambassador herself, and now is in advanced talks to sell her loss-making brand. In fact, for Nykaa, it's in line with the consolidation phase to really acquire more brands under its umbrella and also enhance its bouquet of products. Now, as a trend in this particular space, large companies have been buying emerging brands in direct-to-consumer segment. But Deepika Padukone, brand ambassador for Nykaa, entering into a deal to sell her label as well. With that, it's a wrap on this edition of Profit 360, but do stay tuned to NDTV Profit for all the news and updates. Thank you so much for tuning in.
Presenting the all-knowing, all-powerful Tech Guru.
Whoa. Guru? I'm no guru.
Okay.
I'm just a guy who loves his tech.
A show where the mysteries of megabytes and motherboards shall be unraveled.
Bro, nobody talks like that anymore. This is all about connected ecosystems, EVs and AI that you can use in your daily life. That's what we do on Tech 360. Real talk, real reviews, tech that you can actually use.
Tech has changed. So should your tech show.
Hi, I'm Tamanna Inamdar. Watch me on NDTV Profit, where I break down the day's biggest business stories. What happened, why it matters, and what it means for your money.
Hi, I'm Neeraj Shah. Watch me on NDTV Profit for the most incisive market intelligence and meaningful corporate conversations.
And I'm Alex Matthew. Markets, mutual funds, insurance, personal finance. I help you cut through the noise and make smarter financial choices. And here's where you can watch us.
To understand the Tamil Nadu twist, join me in the midst of our people, language and politics. Vanakkam Tamil Nadu, here we come.
Hello and welcome to KYC. I am Sharath Dubey and you are watching NDTV Profit. Let's start the show. I'll give you some hints about this very interesting company which I have got. And also the first one hint is it's a pet waste recycling company. You heard it right. It's a new industry. Let's get in more details about it. The second hint I would like to give you is a big government boost and was announced, and that's why there has been a good rally in the stock. Highest ever volumes were seen recently in this, and you will be surprised the stock is up more than 62% from January 2026 lows. Very interesting company, but I would like you to understand what the company is all about, and the company's name is Ganesha Ecosphere. But apart from this, let's also talk about what are the key important developments coming in for the company and why are we calling this company? Is company mein khas kya hai? That's the main question. It's a small cap company, but I'll get you more details about it. The new government mandate on recycled PET, will it accelerate the adoption? And if that happens, will it benefit this company? Of course, this is one of the larger players in India in this segment. Of course, the market share and the key triggers for growth, what are those, especially on the capacity expansion, is something which I would be watching out for, especially the Odisha plant. Of course, the impact of elevated crude prices on the raw material and sourcing, is it impacting the company or the spreads which are increasing actually benefiting the company? We'll be having a watch on that. The expansion and growth plans, especially on the Odisha plant, that is what the street wants to know. By when will it be completed and how much incremental benefit will be coming to the numbers? Capex plans going ahead and the capacity utilization. How much are the current capacity utilization standing for the company? These are the important questions we'll be asking for Ganesha Ecosphere. And overall, the margins growth outlook will be also important because the margins have been under a pressure, and let's see if that has bottomed out or not. And the big question is on the ROCE improvement, because the company is focusing on high margin value added products. And to give us more perspective, Yash Sharma would be there. He's the director at Ganesha Eco Pet. Now, this is the 100% subsidiary of Ganesha Ecosphere, and a lot of action is happening in this subsidiary. So that's why we have taken this subsidiary's spokesperson to give us entire perspective. So Yash should be there with us, joining us later on. But company करती क्या है? कानपुर की company है ये, Ganesha Ecosphere. Interesting name, very modern, to be honest. The company is, especially, but look at the foundations. It happened in 1987, so it's not very old also. the thought process. It was there from 1987 onwards, so very nascent industry still now, I would say. Recycles over 16 to 18% of India's PET bottle waste. That's so much important. Ganesha Ecosphere is his 100% subsidiary of Ganesha Ecosphere, where we'll be discussing about the company and also the legacy businesses as well. The new business, Ganesha Ecopet, is your PET for packaging mandate related. So this is what the overall view is for this arm. The manufacturing units are there in 3 places, Kanpur, Rudrapur and Bilaspur. So it is separated properly, at least for the sourcing on this space as well. Apart from this, let's look at the cumulative capacity, and that's strong, 118,800 tons per annum, likely to go up on the next 2 years. We'll have our eyes on that. But आगे क्या करते हैं? Customers, Coca-Cola, PepsiCo, HUL, Bisleri, Asian Paints, anything which is bottled, which gets crumbled, gets processed, then it comes under various fibers and yarns. This is how simplifying this entire story of Ganesha Ecosphere is. These are the key customers you should be watching out for. And going ahead, what has actually been there? This product is used where? It's used in manufacturing of textile related products and fillings. This can be your everyday wear, this can be technical textiles, and Q3 numbers were but very disappointing. The standalone business was offset by the down growth in the arms operations as well. Some kind of issues were there in the capacity utilization, especially on the Warangal plant. Group's filament yarn recently qualified with a leading global textile brand, and this augurs well. More and more global textile players come with them. It augurs well for the company. So it's a mixed kind of a views coming in the Q3 numbers. Capital utilization of Warangal business, that's where it declined to 50%. Of course, impacting the sales also, and the margins, single digit margins there. Will it change? That's the big question. Sales number also was impacted. So Q3 was not that great. But of course, we'll check the history also of the company, how things are planned out. And the most important thing and the trigger of the stock is the extended producer responsibility. Look at the recycling targets which has come in. These are the 4 segments: plastics, packaging, multi-layer and compostable. Look at the overall headroom which is there going ahead, and this is the FY29 use target coming in. This is for, of course, the reusable components. If you could just show the other key targets also, this also includes the reusable target of 25% for rigid plastics. So जितना ये target बढ़ेगा, जितने segment की मैंने बात की, उतना company को फायदा होगा. This is how simplify you can do that. But is the company in a sweet spot? Yes, it is. First mover advantage in PET recycling, that's what is there. Secondly, the regulations are turning favorable for Ganesha Ecosphere. So this is very much important, benefits a lot from it. Also, the third important reason is a significant volume-based buying was there last week. And you could say this was almost the record level of momentum happening. It has a better integration and expansion plans compared with the peers who are there. Largely, they are in the unorganized space, but nevertheless, important. Valuations remain comforting. इसका भाव 2000 के ऊपर था. Of course, अब जो है 1000 के पास आ गया भाव. So still valuations are comforting. So this is why Ganesha Ecosphere is in a comfortable spot, and maybe from current levels also there might be alpha. But to give it more perspective, we'll have our 8 rating parameters in KYC, जहाँ पे हम आपको बताएंगे आपके income statement, balance sheet, cash flow, how do they work, return ratios, is it good, bad, or will it improve, and also shareholding pattern, how things have changed over the last 3 to 4 years, street cred, how much money has been made, and of course, congratulations to folks who have recently invested in the stock, good up move coming in. Valuations will compare the company with itself. We just want to give an apple to apple conversation, and the outlook, especially on the industry tailwinds and what company is doing. So all of these 8 rating parameters will judge Ganesha Ecosphere. The first one is income statement. Let's look at that, and the numbers are pretty decent. FY23 से 25 के 3 year CAGRs देखेंगे तो largely we see 13% revenue growth coming in, but वही EBITDA and PAT has been decent, but there is a little bit of disappointment. Where is the disappointment? That's in the third quarter. That's why we saw a big sell-off happening post the numbers. YOY basis, the revenue, EBITDA, everyone tanking, and the biggest concern for me and for a lot of investors was a single-digit margin, 8.64. And if you just highlight the margin trend also, we'll see that's where the disappointment comes in. हर बार 10 से लेके 15% का एक margin band है, but now that has gone down to 8.6%. Of course, sequentially, there was a little bit of uptick, but has the margins bottomed out? That's the big question we'll be asking. And by when can we get the double-digit margins? That is where the street is concerned about the stock. But net to balance things out, it's a neutral rating when it comes to the income statement. Let's talk about the balance sheet, how important this is. Yes, the borrowings have gone up. Company is going for an expansion. We can understand about that. But net, the debt equity ratio for this company or in the industry is still stable. Cash bank balance is also healthy at 122 odd crore rupees. So net, we could say that the balance sheet is having a neutral rating as of now. So we spoke about income statement, we spoke about balance sheet, but cash flow is very much important as well. There is a little bit of lumpiness involved in this business as well. But net, the cash flow from operations and the PAT has been done well. The conversion is decent. And if you look at the net cash flows coming in, remember investing and financing activities is also very much important. So there will be lumpiness if you study a cash flow for a company like this or even an industry like this. But this time it's doing well as of now for the FY25 data. But let's keep it neutral when it comes to the cash flow segment. Now let's move on to the return ratios, and of course the ROC numbers I have taken. Largely in this kind of a business, the legacy business is there, so आपको ज़्यादा ROC मिलेगा नहीं, 10 से 12% का ROC मिलेगा. But as and when we see things moving to the value-added segment, that is where the ROC starts changing. Currently, they are 40% value added, they are aiming 65%. Then we can expect a 14 to 15% ROC business. So right now it is decent. Little bit of recovery has come in FY25, but really will it be a 15% ROE business? Only time will tell. So right now, it's a neutral rating. Let's talk about shareholding, how much things have moved around, and largely from March 24 onwards, promoters have taken stake, and that's what we have seen, that up move also coming in after that, especially in the mid of January. That is where the stock started going up. Of course, there is a relation with crude also. We'll try to understand spreads mein kya fayda hota hai, but FIs they have sold, but promoters have taken, and the DIs have been pretty much stable. But recently, last week, there's a massive volumes coming in, and guess what? There is some institutional buying coming in, and on that basis, I would like to give a strong thumbs up to shareholding. So interesting names which we have talked about. And let's talk about the street cred, how things have moved. And of course, congratulations to the folks who have entered the stock in the last 2 months. You have made a lot of money. And of course, see from the January, almost you could say February 26 or January lows, it's up 62%. So congratulations on that. But over the last 1 year itself, despite this up move, the stock is still down 26%. 2,000 rupees share price is something which we had seen earlier, but then there was a big sell-off happening. And the last 5 years, if we talk about it, that is also, stock has given a decent return. It's almost up 90% even after the correction as well. So it's pretty much important to track. And street cred, I would like to give this a neutral rating as well. So street cred is done. Let's talk about valuations. And in our valuations, I've taken the 12-month trailing P ratio. So there was the euphoria regarding this recycling theme 2-3 years ago, and the 5-year peak, look at that, 135 times. But after that, normalization happened of the industry. There's of course a lot of dynamics at play for a company like this, and there is a gestation period as well. And the 5-year average was 49 times. And even after the up move which has come in the stock is still trading at 27 times. It's a 12 months trailing P ratio. That means valuations are now also pretty much there for a re-rating, and they look attractive. So net, when it comes to the valuations, I'll be giving this a strong thumbs up as well. Let's talk about the outlook. Outlook is very much important. This is one of the reasons why I've got this company in KYC, so that you understand where the future is lying. The government's new PET mandate to accelerate its adoption, that is where the trigger has happened. And a lot of other factors are coming in. The second one I'd like to point out, the key outlook, is the increasing PET granules capacity, which the company has already announced in its exchange filings. When does this happen? When is the completion of it? That is what we'll be looking out for. The third important thing in the outlook to look at is the target revenue contribution of the value-added products to 65%. Currently, it's around 40%. And if that happens, your margins and the ROEs both improve going ahead. Apart from that, the capitalization on the regulations, and one of the few companies to have a large B2B unit. They have backward integration also. So the moment this industry goes up, the benefits and the higher market share gains is something which Ganesha Ecosphere will have. And that is something which I will also be focusing on, but it takes time. There is a gestation period to it. Nothing happens so fast in this industry, and that's what we have seen. So we see a strong thumbs up coming up for the outlook. But let's revise the KYC ratings. What numbers we have given? Kya ye company pass hua hai ki nahi? That's the big question to be asked. Of course, the numbers we see were pretty decent. Income statement, balance sheet, cash flow, return ratios. It looks very stable, but nothing out of the park. Neutral rating. Let's see what else is there here where can get some value out of our analysis. This also includes the shareholding. That is where the volumes are picking up. Promoters are buying stake in the company. Valuations are very much sustainable right now at these current levels, and there might be a re-rating. And the outlook, that is where the alpha is there, especially where the government mandate has started coming in. And after the stock, being beaten down, there is a good up move coming in, especially technically. And that is why we have given this company a final rating of 5.5 out of 8. It's largely it's neutral to positive, but it's a very developing story, and we will be judging this company every 6 months to understand what happens and to put everything in perspective. But joining us to give us more flavor of the entire company is Yash Sharma. He's the director at Ganesha Ecopet. I would like to welcome Yash. Good afternoon, Yash. Always a pleasure to have you. The most important thing why I'm very much interested in Ganesha Ecosphere is the government's central mandate which has come in, where the increase is there of the key products. You just explain us the government's mandate and how much beneficial it is for Ganesha Ecosphere.
Hi, thanks. Good morning, everyone. Thanks for having me here. And yes, definitely after the government's new mandate that has come into picture, actually the mandate was in place last year itself to have minimum 30% recycled content in all rigid packaging applications. But there was a lot of confusion. A draft came out in the middle of the year in June, after which the usage of recycled plastic by a lot of converters and brand owners was delayed or stopped. There was a lot of confusion around the mandates of what's the new mandate's going to be. So finally now on 31st of March, the government of India has released a new mandate where it has stated that for 2026 to 2027, 40% recycled PET, recycled plastic has to be used in category 1 applications. And along with that, the last year's requirement of 30% has also been carried forward and is to be covered in the next 3 years by doing minimum 1/3 of every year. So which will be basically going to create an environment for a very high volume demand for the recycled plastics. And it will also obviously help us, Ganesha Ecosphere being the largest in this space currently in India and the biggest organized player in this space. We are already working with so many brands, so we definitely stand to benefit massively from this new mandates.
And Yash, just to get in a little bit of numbers, what kind of incremental benefits we can expect for Ganesha Ecosphere and the volume growth outlook? Does this change now, because there was a pressure in your numbers which we have seen in Q3 also, but I don't want to talk about Q3 because it's the past. I'm talking about the future. Is what is the incremental benefits, and if you can quantify or give me a range, your volume growth outlook or something addition coming in your top line?
Surely. So we have a current capacity of about 42,000 metric tons, which is already fully operational and live. Now, last year, what happened is that more or less from April to December, we have been able to operate that capacity on around 50 to 55 to 60% utilizations on and off throughout the year. That was because there was so much confusion and the demand offtake for the recyclate was not very clear. So this capacity utilization, which was at about 50 to 55% for the good part of the last year, will now be operating at north of around 90% levels because of the good, strong demand that is now there in the market. Also, what we're benefiting right now is since the virgin plastic prices, because of this Iran war, the plastic prices of virgin has increased by about 30 to 60% based on plastic to plastic. In case of PET, there's an increase of about 45%. But in case of our recycled plastic, which is recycled PET, the price increase was around between 10 to 15% range. So it has also benefited us economically and has led to a big demand, creation in the last 1 to 2 months. We think that going forward with the mandate in place, we will be able to operate our existing 42,000 tons capacity at very, very optimum levels of 90% approximately.
Right.
And the new...
Yeah. Right, Yash. Just a query on that. Right now, you're having a 90% capacity utilization coming in. Everybody is wanting to know about the Odisha plant. What are the date lines? What are the capacity addition which will be coming in? Because there was an overhang in the stock because we needed extra capacities to come in, and it takes time in your industry to make things happen. It's not something like happens in 2-3 months. It takes 12 to 18 months, 20 months. There are some delays which we understand. I've tracked the company for the last 2-3 years. But now, what are the key timelines? Everybody is wanting to know that.
So what we had done is we had changed our strategy because of the last year's muted demand. We changed our strategy and we have now divided the capacity expansion into brownfield and greenfield. So we have already upcoming about 45,000 metric ton capacity expansion in brownfield expansion at our Warangal unit itself. And the Odisha plant, though it was delayed last year because of the muted demand, we will now be going forward to take the right decision of how we want to go forward with it. Obviously, now with the mandate in place and the clarity in place from the brand owner side, we'll be going forward and, in the next 2 years, we see that we'll be able to do more greenfield expansions.
Right, and just could you give us some numbers to it? What can that be with Odisha, especially the completion? You said next 2 years. So by when it can get operational?
By FY 27-28, we think it will be operational, the new greenfield capacities.
Right. So it's another 2 to 3 year odd story coming in for Ganesha Ecosphere. But Yash, I just want to understand with the raw material pricing, you spoke about the recycled plastic has not gone up as such. But for you, your sourcing costs are also a bit can get higher, right? Because there's a lot of derivatives that play from crude. How much of that will impact on your margins, especially in Q1 or Q4?
So definitely the raw material cost for us also has gone up by 10 to 15%. But then what we do is we have a understanding with our customers in terms of having a pricing formula which takes care of the increase in the raw material prices. So, it's obviously during volatile times, it's very difficult to manage, expectations on all the sides. But once things are stable, I think we'll be able to achieve our healthy margins because we have a very close relationship with our customers to be able to, adjust the raw material, price fluctuations in the final granule prices.
Right. Of course, the granule price is something which we spoke about. But Yash, just try to understand the margin outlook. This Q3 numbers was below the 10% mark. Your company has double-digit margin history all throughout, and now the dip is coming in. And there was a slight bottoming out if you compare Q2 and Q3. But yes, is it now that we are back to the double-digit margins in fourth quarter, or would you like to wait it out, say, from the second quarter of FY27?
Yeah, so I think that we should be able to see incremental improvements in the margin profiles going forward with the new demand. Q4 also, I think we should be able to be slightly do better than Q3. Hopefully, it's still under preparation as we speak. But I think we should be, the volume profile and the offtake was definitely on the positive side. Going forward also, we think that we should be able to reach our optimum, standard margin levels we were targeting earlier.
And I would think that's fairly a substantial buffer to hold. This is not an involuntary outcome, as many in the opposition, in the political domain, many in the opposition would wrongly believe or would want to say that in such a word, but it is a wrong belief. It's not an involuntary outcome. It is the product of deliberate, sustained, and sometimes politically difficult choices made over the years of fiscal management. It was made possible because of the agile policies, stable leadership of this government, with a singular focus on ensuring India achieves Godspeed progress. For a rapidly progressing economy like ours, sound fiscal management is a policy imperative. And in this front, we have undergone a massive structural transformation of public finance over the past decade. Under Honorable Prime Minister Modi, we have credibly changed the course of the fiscal policy from consumption-led deficits, which was marked during the era before 2014, to productive investment-led consolidation. It's a distinct change in the character of how public finance is managed. I've come to appreciate one thing, a particular dimension of public finance that receives insufficient attention in both academic world and in policy debates. Not merely on what to spend or how much to spend, but when to spend. The timing of public expenditure is itself a macroeconomic instrument, temporal efficiency, if you may want to call it. We have strongly pushed just-in-time releases for our budgetary allocations. We have leveraged the public finance management, financial management system, the PFMS, in its fullest potential. Through the PFMS, the SNA Sparsh model for release of funds under centrally sponsored schemes was brought in. It marked a transition from a credit push, that is a priori release of funds to various implementing agency, to a debit pull based fund transfer system in which a debit to the central pool is triggered only when the implementing agency issues a payment instruction on the system. It doesn't start before. By design, therefore, SNA Sparsh can pull funds in real time to the end beneficiary's account, saving resources for the Treasury. Similarly, the Treasury Single Nodal account facilitates just-in-time release of funds to autonomous bodies. This eliminates funds remaining unutilized for a long time. It has resulted in substantial interest costs for the center. India is also sharing these digital public goods and public financial management, the PFMS tools, with countries across Africa, Latin America, and Asia through MOUs, pilot implementations, technical missions, and capacity building programs. Just to give you an idea of what I'm saying in terms of numbers. In the year 24-25, mother sanctions, as they would call, which will be for umbrella sanction under which you may have several programs. Mother sanctions was 24,369 crore.
I'm Tamanna Inamdar. Watch me on NDTV Profit, where I break down the day's biggest business stories. What happened, why it matters, and what it means for your money.
Hi, I'm Neeraj Shah. Watch me on NDTV Profit for the most incisive market intelligence and meaningful corporate conversations.
And I'm Alex Matthew. Markets, mutual funds, insurance, personal finance. I help you cut through the noise and make smarter financial choices.
And here's where you can watch us.
Presenting the all-knowing, all-powerful Tech Guru.
Whoa. Guru? I'm no guru.
Okay.
I'm just a guy who loves his tech.
A show where the mysteries of megabytes and motherboards shall be unraveled.
Bro, nobody talks like that anymore. This is all about connected ecosystems, EVs and AI that you can use in your daily life. That's what we do on Tech 360. Real talk, real reviews, tech that you can actually use.
Tech has changed. So should your tech show.
To understand the Tamil Nadu twist, join me in the midst of our people, language and politics. Vanakkam Tamil Nadu, here we come.
When others are warming up, I'm raring to go. The stories that matter, the stories that shape your life.
Hello and welcome to watching Prime 5 with me, Raisha Sehgal. What's that today? How to
The show that sets the prime time agenda.
We'll be deep diving into this topic to tell you what's at stake.
Join me, Raisha Sehgal, on Prime 5 only on NDTV 24/7.
Whistle to success in Tamil Nadu. To understand the Tamil Nadu twist, join me in the midst of our politics and people.
Hi, we're talking about Your Money Matters on NDTV Profit, and my name is Alex Matthew. Is this the right moment to go out and buy a house? The question I'm asking is that, and that's because the scenario that we're currently in is highly uncertain. We don't know the outcome of the geopolitical crisis that's currently underway in West Asia, and we don't know what's going to happen, therefore, to crude oil prices, to markets, and to everything else. So, is it a good idea to buy a house in 2026, or should you hold your horses and maybe push that decision down the line? Are you losing anything by doing that? I'm joined today by Harsh Kumar, who's managing partner at West Financial Services. Harsh, thanks so much for taking the time. Let me first ask you about this, right? If suppose you, assume that I'm coming to you for advice, Harsh, and I'm saying that this is a house that I need to buy for my own purposes. I don't intend to use this as an investment. What are the first few questions that you would ask me?
So Alex, you started the introduction by saying that, there is a crisis situation and we don't know how the global uncertainty will pan out. So let me clear out first thing first. So if you look at real estate in India, it's driven by 4 to 5 variables. One is how has been the income growth in the country for the last 1 to 2 years, how the interest rates, where we have seen Reserve Bank of India going aggressive in terms of rate cut in last 1 year. How has been the urban demand, because most of the real estate prices in India appreciate on account of nuclearization of families and then urban demand. And lastly, how has been the supply of quality projects? Now, of late, we have started hearing this question a lot about real estate that you were mentioning, primarily because the last 3 to 4 years, we have seen real estate appreciating a lot. And now we have reached a critical juncture where there is a kind of stagnation in the prices. And that's the reason a lot of people who had FOMO, they are now wanting to enter this. Now, if somebody comes to me and asks that should he or she buy a house which they have been anticipating, my first question is, it's not about global factor. It's not about anything else, but it's about, are you ready for real estate or not? And when I say, are you ready? There are a few critical checklists which you should have at your end to see that. First is, if you're already paying some EMI, be it on your car loan or be it on anything else, add that EMI to the new anticipated EMI, which you may get on account of taking a mortgage. Put together, both the existing EMIs and the new EMI should not be more than, say, 30 to 40% of your net take home. And here I would want to reiterate net take home and not gross take home. Second, you would have to pay some down payment also when you're buying a house. By paying the down payment, are you reaching a situation where you would not have emergency funds, which is equal to your spending of next 6 to 12 months or not? You should be very clear about it. Third is, are you paying the down payment by wiping out your investment? Say you have invested in stocks, gold, mutual funds. Is it that you are liquidating everything to enter into real estate? Then you need to pause and rethink about it. And lastly, you should also be very clear that how is your job outlook going to be for next 3 to 5 years? So if you're in a business, you should know how your business is going to be impacted because of geopolitical reasons or because of local factors. And if you are working somewhere, you should be very clear whether any change in the world, be it AI or be it anything else, can make you reach a situation where you can either lose your job or where you can see a reduction in your salary. Now, if any of these things is, playing against you, then I would suggest you should take a pause and think about it. Second thing you should also be very cognizant about is that when you're buying a house, you should have a view that you would stay in that property for 8 to 10 years. I'll tell you the reasons why I'm saying that. When you buy a house, you have a registration cost, which is 6 to 8% depending on the state, which is a very high cost. You have a cost of interior, you have a cost of fixture, you have a moving in cost. Now, if you add all these costs, unless you stay for 8 to 10 years in the property, it doesn't make sense because the cost does not get apportioned significantly the way you would have wanted to. Second, you also need to see rental yield in the micro market where you are going to buy. Let's say today you are thinking that you will stay in that house, but after 2 years there is a job situation change and you want to give it on rent. You should be very clear if you're getting good rent or not. And when I say rental check, don't ask the builder, don't ask the broker. Just go to No Broker, just go to Magic Brick, see what are the kind of rents which are prevalent in that micro market. And that will give you an idea whether if you don't stay, you will make healthy yield or not. Also, you need to be very clear if you are over leveraging by going into real estate. On one hand, you may have 2 car loans which are going on. On top of it, you are doing this, and then you are not certain about your job. Now, this is a very deadly situation, and you should avoid that. Now,
but before we get it, so there are several things that you've covered, Harsh, in that, but I want to delve into some of these aspects in some more detail, right? The first and foremost is when you're making this down payment, a lot of people have this as a major life goal. And I think less and less people are now thinking of this as a non-negotiable, or at least they're willing to push things down the line if they feel that they're not ready at the moment. You spoke about when you have to liquidate all of your assets and why that may not be a good idea. Particularly in the context that we're in right now, where equity markets have underperformed over the last 2 years. And a lot of people are now saying at this moment that it might be a good idea to allocate more money towards equity. Why is this not a good time to perhaps sell all of your equity or sell of your investments and move into real estate?
So, Alex, like I was mentioning, that real estate is not about market uncertainties. It's less about timing and it's more about your situation. Let me explain that a little bit. Now, when you're buying equities, there is an easy way in which you can diversify your equity. You can, in 500 rupees today, buy 50 companies through an index fund, through a mutual fund. In real estate, you're buying a single asset, which is at a single location, in a single micro market where you don't know how the behavior is going to be over 10 years. So maybe, yes, equity is beaten down at this point of time. But what if the real estate that you're going to buy does not yield you any return over next 10 years, not because of any other factor, but because of local factors? So that is about concentration, which I thought I'll touch upon. Second is, like in equity, we talk about price to earning ratio. So when you were mentioning that equity is beaten down, it looks attractive. One of the variables which is at the back of your mind is you would be thinking about price to earning ratios, and which is the relevant ratio, not the most important, but relevant. Similarly, in real estate, we can have price to rent ratio. So where you can take the price of the house divided by the annual rent. Now, there, the current ratio in India, which is prevalent, is in the range of around, say, 25 to 40. But if you are getting a house where the price divided by the annual rent is less than 15, similar to equities, it's a good idea to look at that asset. Overall, not just from staying, but from an appreciation point of view also. But if it is 25, 30, those kind of ratios, then it may take you very long to recover that money. And I don't know whether you will ever make yields which are better than even fixed deposit or not.
So this is from the perspective of an argument of between equity as an investment, obviously, which is what it is, and real estate also as an investment. But I'm speaking about the, not necessary, I'm talking about a situation where you're buying a house that you want to live in, Harsh. And I'm talking about the timing and the scenario as things stand right now. You would hypothetically have saved for the last 5 to 7 years. Let's assume that you started post COVID-19 and you've made a pretty decent, hefty portfolio. Now is the time when you had planned in 5 years, I will buy a house. And this is that moment. My question to you is, should you, given the kind of scenario the market is right now in, and where you normally would reallocate towards equity, still liquidate everything?
I would not suggest. The only advantage of doing that is you end up paying lower taxes because your capital gains would have come down in last 2 months or so. But, it's better to pay capital gains on gains rather than not paying taxes because you don't have any gains. So I would not suggest that, because generally when an asset class is beaten down, it is better to give it some time, let it tide over, and then think with a calm mind what you want to do. So there would come times, when equity market would look expensive, but the real estate may be hovering around the same price at which you are looking at right now. And at that point of time, if you are wanting to build a physical asset, you can take that call, but not at this point of time, because the risk reward at these levels of equity valuation is more favorable for rewards in the medium to long term.
Speaking a little more about timing, and these are always psychological pressures that come into play, right, Harsh, which is that you look at the market and these are usually very chunky assets, very costly assets, real estate.
Right.
And so therefore you talk about the cost of a property in Mumbai or in New Delhi or even in Bengaluru, which can go upwards of 2 crores or 2.5 crores if you're buying a sizable apartment, right? So you look at the price right now and say, what if in 5 years' time the price is 20% or 30% more? I may not be able to afford it then, so I can stretch a little now. Why is that not the best argument?
Because, Alex, your money is not going to lie idle. So even if you don't buy real estate today, you would be utilizing that money and putting it somewhere else. And that money would also yield the return. Now, you can always have an argument that in real estate, I'm leveraging, because by paying 20 rupees, I'm buying a property of 100 rupees. And if there is a gain of 20-30%, overall, then the same gain can translate to a much higher amount of profit on my base money. But so is the case with equity market, because if equity market delivers better return, then you can leverage your trade there also and make return. What I'm trying to say is that I am not for a moment saying don't have real estate. And there are a lot of advantages of having real estate also, which we will discuss during our conversation. But if you have money which you can earmark for something where you see better appreciation, you can do that rather than looking at a single concentrated allocation at this point of time. Or the third approach could be that you can have a balance of both. You can say that, okay, some amount of money which I have got as a bonus last week is lying with me. I will put it into real estate as a down payment. Remaining, I'll take an EMI, and some amount of money I'll put it into equity market. We don't have the predictive ability of what will do better. But if either of those two do better, at least you would have allocation to one of those two baskets rather than being lopsidedly or skewed allocated toward one asset class.
So suppose in my hypothetical scenario, I've managed to accumulate over the course of the last 5 years by investing both myself and suppose my partner is also investing. We started with a certain amount of capital and we managed to push it up to 75 lakhs to 1 crore. And you've established a certain base. How much is it okay to dilute from that in order to buy a house? Because you're talking about a situation, Harsh, where the potential to grow from this stage, if I'm investing, and suppose I'm in my 30s, right? These are all hypotheticals, and everybody's scenario, I must point out, can be very different. But I'm saying in this hypothetical scenario, at 35 or 40, for the next 20 years, this 1 crore could potentially grow very sizably if it continues to remain invested. However, I still need to buy a house. So how much is it okay for me to take out from that? and how much is it okay for me to take away from my longer term goals?
So first thing first, Alex, whatever is your liquid portfolio or whatever is your liquidity, you should chart down how much is your expense going to be if you lose your job tomorrow. So if hypothetically you and your partner lose job tomorrow because of, like I mentioned, AI, or because of geopolitical uncertainty, or because of anything else, then you should have sufficient money to take care of your financial requirement for next 6 to 12 months. So let's say you have accumulated 100 rupees. Your next 1 year expense, if you lose job, is 13 rupees or 15 rupees. Keep that aside. That you can't touch. That has to be in your contingency basket. Second would be how much of that money at this point of time you would want to continue in equity market, also by not overstretching on your EMI. Now, it should not reach a situation where you take a higher loan and the EMI reaches, 55, 60% of your net take home. That is a stretch for you on a monthly basis. So instead of doing that, you go for an EMI, which is 35, 40% of your overall net income. And remaining amount you can invest in the market through systematic investing also. So that is the second approach which you can look at. Third is that at any point of time, you should not be fully illiquid beyond your contingency fund also. So one is your contingency fund, which is, 13 to 15 rupees, which we discussed. Beyond that, keep, 10 to 15 rupees or 20 rupees as your liquid basket, because there could be some opportunities which might come your way. B, there could be some health emergency which might require some money. I'm not saying that you would not have health insurance, but still there could be some requirement. C, there could be some requirement at a family level which could arise, which you're not anticipating at this point of time. So given all these constraints, maintain a fine balance between how much down payment to have, how much should be the EMI, and how much should you keep as a liquid asset for A, any opportunity, or B, any contingency, in addition to the contingency or the buffer surplus, which you would have marked as your 6 to 12 months of expense.
Understood. One argument, Harsh, that I keep hearing, and it's been more than a decade, I've still kept hearing it, which is that if you're paying rent, then it's money lost. Whereas if you're paying an EMI to buy a house, you're building an asset and you will eventually own a physical asset. Is there something wrong with that argument?
So I would say that yes, there is a conceptual flaw with that argument. Now, let's look at what is EMI. Let's get to first principle. EMI is interest plus principal that you pay to the bank on a monthly basis for the amount of money which you would have borrowed at one go. Now, in the first few years of your loan, let's say you have taken a 20 years loan. In the first 5 to 7 years, the interest component is going to be much higher than your principal. Now, philosophically, if you see, principal is what is building your asset and interest is an expense which you're paying, similar to the rent. So if I have to, bullet point it in, a simple sentence, rent is 100% expense, but EMI is also partially expense and partially investment. Now, the second part of the argument is, if you are staying at the same property, let's say you like a house and it's available for you to be taken on rent or to be bought. If you're taking that house on rent, rental yield in India is around 2.5% to 3.5%, while the home loan rate in India is 7.5% to 8.5%, which means in the first few years, the amount of rent that you are paying is 1/3 the interest that you are paying on the loan. Now, in the following year, it changes, but in the first 2 to 3 years, you are actually saving a lot.
Why do you say that? Why do you say that, Harsh? For those people that don't understand the way that EMIs are constructed, do you want to describe why that is?
Because of two reasons. One, like I mentioned, that in the first few years, let's say, I'll give you an example with the number. You take a loan of 100 rupees today. And in 100 rupees, the rate of interest is, let's say, 8%. Now, what is the rate of interest on the first month that you would have to accrue for the year is 8 rupees. 8 divided by 12 is your first month interest. Now, if you're taking the same house on rent, the annual rent could be 3 rupees. So if I have to simplify it, I'm not getting into the complicated calculation where each month you are paying principal and your interest component is reducing. But at a simple level, in the first year, the rent you're paying in that house is 2.5 to 3 rupees. Interest that you're paying on the loan is 8 rupees. 3 divided by 8 is almost 1/3. Now, after 5-7 years, the calculation changes because your rent keeps on increasing, but your interest keeps on reducing. So after 5, 6, 7 years, you may reach a situation where your rent is higher than the initial interest cost that you would have paid because the interest cost would have come down. But along with that, now let me get into certain finer points. One is the flexibility versus commitment. let's say you are staying on rent, you get a better job offer. You are in Bombay, you get an offer which is 20 kilometers away. If you are owning a house, you may think that let me not change my job because where I am working currently is very comfortable to me. It's near my home. If your child is getting admission in a better school, which is again 2 hours away from your home, you may again compromise thinking that let me not take that call because it will be far away from my home. So what you're doing in your mind, you are not taking a decision which is rational, but you are taking a decision which is emotional by keeping real estate as the center point of your decision-making variable. Third is the opportunity cost of capital. You have given down payment, you are giving EMI, and tomorrow market cracks another 10%. The valuation become very attractive like they were in COVID period, but you don't have liquidity to deploy, so you are trapped there. And lastly, what we have discussed earlier, like concentration risk and all those things. And one more thing you should always keep in mind, that when you buy real estate, there are certain additional costs also which come in your mind. So when you're staying on rent, you don't have to pay property tax. That's the headache of landlord. You don't have to bother about repair and upgrades. That's a headache of landlord. You don't have to bother about maintenance, provided it's a part of the rent. Your landlord has to take care of this. Here, everything falls on you and you have to take care of all these costs. So it's not just EMI versus rent, but it is EMI plus a lot of other costs versus rent which you end up paying.
Speaking of other costs, Harsh, and you've probably given advice to a lot of people in this situation, right? And you mentioned this briefly at the start. You were talking about stamp duty, you were talking about certain other costs, brokerage perhaps, you were talking about fixtures. I found that a lot of people do not really calculate this when they say that the cost of a property is 1 crore, say, or the cost of a property is 1.5. I've heard people estimate that you can go at least 30% over that to say that that is going to be the cost of fixtures and tax and everything else that you would have to pay. Is that a fair assessment or is it more or less?
So, Alex, I would also want to mention one more point, which we didn't discuss till now, and maybe I'll discuss it after this. What is the benefit of taking a loan and an EMI? We haven't discussed.
I want to come to that in just a bit. Before we do, we should establish this.
Right. So, yes, there are two ways to look at it. One is a simple rule of thumb where we say that, okay, whatever is the property value, 20% of that is for interiors and home improvement. But if you would want a more precise calculation, then, it depends on the carpet area, how much you want to spend depending on the quality of interior. So if you're looking at a budget interior kind of a thing, then roughly in a market like Bangalore, Hyderabad, Bombay would be slightly higher, would be around 1,000 to 1,200 per square feet. If you're looking at a mid-range interior, maybe 1,500 to 2,500. If you're looking at a premium interior, then it can go as high as 4,000 to 5,000 rupees per square feet. And if you're looking at luxury interior, then it goes beyond 5,000 rupees a square feet. Now, this luxury interior at 5,000 rupees could actually be 50 to 60% of the property value if the property is costing 10,000 rupees a square feet. That's the reason I use the word luxury interior. Now, what does it cover? It covers modular kitchen, wardrobes, electrical fitting, false ceiling, furniture, appliances, curtains, all these things are covered in that. And you should also keep one more thing in mind. Whether you're buying a new house from the builder or you're buying a resale. If you're buying a new house, then the cost of interiors and all increases significantly because you get a bare shell. If you're buying a resale home, then I'm assuming that the first buyer would have put in, these modular kitchen and wardrobe and other things. So maybe furniture cost would be extra for you, but beyond that, a few of the things would have already been covered.
Yeah, that's a fair point. Through the conversation, it's been close to 20 minutes so far, Harsh, and we've pointed out a whole number of reasons why maybe buying a house is not the best idea. But there are several reasons why buying a house could potentially be a good idea as well. And we're not necessarily saying, before people think, and I think it might be a little late in the conversation to say this, but we're not saying that people should not buy and own a house. We're talking about when this should take place. So, what are the reasons why somebody should definitely consider taking a house and maybe taking a loan?
Okay. So, Alex, it's a very interesting question. And this is something which we discuss with most of our investors on a regular basis. So first thing is, if your balance sheet is strong, which means if you don't anticipate job loss, if you're sitting on huge amount of liquidity, and if you are going to stay in that place for 8, 10, 12 years, then it makes sense for you to buy it because it gives you a lot of psychological comfort. Your family feels a sense of belonging, those kind of things. But if your balance sheet is weak, you're uncertain, you're not sure whether you will be staying at that place or not for a longer period of time, then I think it's better to rent. But there are certain behavioral reasons where I would say that buying a house is a better idea. First is, let's say by nature, you are a spendthrift person. You earn 100 rupees in a month, you end up spending 70 rupees in that. Now, if you're buying real estate, then because of EMI, because of down payment, there is a forced saving which you are doing. Now, it's a behavioral nudge for you, but in the end, you are not a person who's going to do, SIP or who's going to invest into mutual fund because that is not a mandatory thing for you. But once you take a loan, EMI becomes mandatory. So that is an advantage for you. It's a forced asset creation. Second is inflation hedge. Over time, what we have seen is that real estate prices generally move in tandem with inflation. In emerging markets like India, we can have phases when inflation remains high for a long period of time. Right now, we are in a situation where the inflation is benign, but we never know. So in those situations, it's better to have real estate because you have an asset class which is providing you hedge against that. Third is, we discussed it earlier, but I didn't explain it in detail, is the leverage. Now, if you are wanting to buy anything else, let's say you want to do an SIP in equity, you have to put that money entirely from your pocket. You want to buy 5,000 rupees SIP, 5,000 is debited from your bank account. But in case of house, you can pay 20 lakhs, remaining 80 lakhs can be leveraged by the bank and you can buy a property of 1 crore. So from that point of view, that becomes a good leverage play. And if real estate appreciates, your return on the original principal becomes meaningfully strong. So these are a few of the reasons where we feel that owning a home also has benefits, but you need to see in a holistic way which suits you better as an investor.
Okay, last question. This is 2 minutes, Harsh, which is that a lot of couples tend to think of buying a house. What are the reasons why people should think of doing it jointly or otherwise?
So, Alex, there are two dimensions to that, and I'll take 1 minute each. First question which should come to the mind is, should the property be in both the names or not? And my answer is definitely it should be in both the names. There is one advantage which is more from an inheritance point of view. Let's say there are two owners and there is no will, and if one person is no more, then the second co-owner becomes the owner and there is no issue with respect to transmission of asset. But on the other hand, if I own the asset and I don't have any will and tomorrow I am no more there, then it could become an issue where multiple legal heirs may want access to that property. So that is one important reason. But you can always say that I can create a will and I can get done with that headache. Second advantage is on the financial side. If you are buying property where a female is involved, then in a lot of states, there is a stamp duty concession. If you're taking a loan, a lot of banks, they have a lower rate of interest if a woman is a co-borrower or is the primary applicant. If you are in old regime of income tax, then both the individual or both the partners can claim double the tax benefit. So if you see all these things, then property should be purchased in both the name, and ideally the loan should also be in both the names. So you can max out on income tax advantage, you can max out on stamp duty saving, because even if you're saving 1 to 2% on a 2 crore property, it can be 4 lakhs, which can go for your fixtures and all. So, and lastly, the loan eligibility also increases, because if you're wanting to buy a house which is really expensive beyond your income threshold, then that also helps.
Yeah, it's an important point because you have two incomes to consider. Got it. Harsh, I think it's been a pretty interesting conversation, and ultimately this is a decision that tends to also have an emotional aspect to it, but hopefully we've caused people to think in the right direction. Thanks so much for taking the time.
Thank you, Alex. Thanks to all the viewers.
All right, that brings us to the end of this edition of Your Money Matters. Let us know what you think, and do stay tuned. This is NDTV Profit.
Presenting the all-knowing, all-powerful Tech Guru.
Whoa. Guru? I'm no guru.
Okay.
I'm just a guy who loves his tech.
A show where the mysteries of megabytes and motherboards shall be unraveled.
Bro, nobody talks like that anymore. This is all about connected ecosystems, EVs and AI that you can use in your daily life. That's what we do on Tech 360. Real talk, real reviews, tech that you can actually use.
Tech has changed. So should your tech show.
Hi, I'm Tamanna Inamdar. Watch me on NDTV Profit, where I break down the day's biggest business stories. What happened, why it matters, and what it means for your money.
Hi, I'm Neeraj Shah. Watch me on NDTV Profit for the most incisive market intelligence and meaningful corporate conversations.
And I'm Alex Matthew. Markets, mutual funds, insurance, personal finance. I help you cut through the noise and make smarter financial choices. And here's where you can watch us.
To understand the Tamil Nadu twist, join me in the midst of people, language and politics. Vanakkam Tamil Nadu, here we come.
When others are warming up, I'm raring to go. The stories that matter, the stories that shape your life.
Hello and welcome to watching Prime 5 with me, Raisha Sehgal. What's happening? How to?
The show that sets the prime time agenda.
We'll be deep diving into this topic to tell you what's at stake.
Join me, Raisha Sehgal, on Prime 5 only on NDTV 24/7.
Whistle to success in Tamil Nadu.
Joining us on this special segment this morning is Professor Gulshan Sachdev. He looks at European studies in JNU, but of course, there's right now the conflict has included pretty much every major country in the world, one way or the other, in terms of impact. Professor Sachdeva, thank you so much for speaking with us here at NDTV Profit. Just a very basic question first, because we're also speaking ahead of a conference and an address by the US President later tonight, India time. We're hearing what we are from the Iranian side. Is there any real sign of a ceasefire, a truce, or this conflict ending that you can glean?
Well, thank you for having me. I think at the moment, I think there are escalatory, rhetoric from both sides. This could be strategy from both sides, but at the same time, it doesn't look that you have to have any immediate end to this conflict, at least in the next few days or even few weeks. Because what has really happened is in the last 1 month now, it's becoming clear that war objectives of the US and war objective of Israel differ very, 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 radically. So even if US is more worried about winding up this operation, and they're also worried about impact on the energy markets, on the global economy, Israel has a very different kind of intentions. So unless there are very serious talks happening between US and Iran, which at the moment doesn't seem to be the case. Of course, there are all kind of rumors, there are all kind of, talks about happening that, but still you don't see indication of very serious indication of that. So even if United States decides perhaps declaring victory and moving out of this war. But I don't think that Israel and Iran are going to stop this war. They'll continue because Iran is looking for something more serious talk and some kind of assurance that it's not going to be attacked again. And of course, I mean, in one sense, I mean, this is a very unnecessary war because all the thing which US is now asking, whether it was nuclear talk or it was Strait of Hormuz, etc. Those are already open and they were already talking to the US. But anyway, that's history now. So at the moment, it looks like that, the damage is already done to the global economy. So it's not just only even if tomorrow, because, out of 105 million barrels a day, demand of the global economy of the crude, about 20 million comes from this region. And in any kind of scenario, if one is looking now for at least in the next foreseeable future, at least 10 million crude is going to be missing.
But the question is, Professor Sachdeva, the question is based on what we've seen over the weekend as well, and the tone and tenor of the messaging, particularly from the US president, there does not seem to be any off-ramp in sight. And so therefore the question is, can you unilaterally, even if you do announce a victory, are you going to be able to extricate yourself? There is a significant loss on the military side as well of equipment for the US now that it has to bear.
Well, that's right, because, every day it's, I mean, according to certain estimates, about $300 million, the cost of war is, on the US economy. And now already the prices have gone up in the US and it's have its own political impact. And it's also not just only political impact within the US, but also with the transatlantic alliance. There are serious strains there. So US would like to come out and even declaring victory. As I said, even after that, unless there is a serious discussion, serious talk, and serious agreement on this is what Iran would like to see. Because after seeing 1 month, in this war, they have certain appetite to continue for some more time. They are also not really in a hurry, looks like, because, they have already practically controlling the Strait of Hormuz even today. And the US doesn't seem to have appetite to send ground forces there. Even if they move out, I think the situation is still going to be very unstable. And, and if Israel continue to attack, particularly infrastructure and energy infrastructure within Iran, they will continue to attack in the whole Gulf region. And, the instability in this region will continue.
Professor Sachdeva, European countries, one by one, are speaking up against the conflict. The conspiracy theory is that they have been allowed, the ships have been allowed the passage. Do you think that becomes a clear and present strategy in that NATO could actually reach a bit of a breaking point?
Well, I mean, NATO is already facing very serious difficulties. And the Europeans are very clear because, what they are saying that, the US started this war without consulting Europeans. And now when even the US Navy, the formidable, the military power of the US, if they are not really able to open Strait of Hormuz, even few ships coming from the European countries are not going to make a major difference. And anyway, I think within Europe also there are different opinions. Particularly France is very keen that, you can't really forcefully open the Strait of Hormuz. You have to talk to, Iranians. And now, more than, 40 countries, they discussed this issue. Even the Indian Foreign Secretary was also party to that. That issue came to the UNSC, and within the UNSC also, the Chinese have, they said, no, you can't do this thing in force, nothing. Even the vote has been kind of postponed. So what Europeans are really looking first, they may try to come to the, rescue, come to do certain things about the Strait of Hormuz. But first they want a certain kind of hostility to stop and certain institutional mechanism, particularly some legal backing from the UNSC. Then only I think they'll be able to join, and that doesn't look very certain at this point of time. So we are seeing, at least the same kind of thing continue for some more time.
What is this some more time becomes a big question. Professor Sachdev, thank you so much for speaking with us. But a prolonged, painful war with this kind of a situation is definitely not what was required. Harsha Upadhyay, CIO of Kotak Mahindra AMC with us. Harsha, always a pleasure to have you on. And I think one thing that's coming out very clearly through all of the data that we're getting is that even while FIIs have decided to look at other pastures, Indian investors are continuing to keep the faith in markets. Now, do you think that that's justified right now with what we're seeing? There seems to be an underlying sense that this will end at some point and then you should be well placed to make the most of it. Would you agree with that?
I think clearly what you said is right. If you go by the flows that the industry has seen during the month of March or the first few days of April, it's clear that the domestic retail investors have continued to participate in equity market and continue to pose faith on Indian equities. Yes, we are in the middle of volatility. Very difficult to take a call in terms of where it's going to end, exact impact of the war, etc. However, time and again, we have seen that when you're in the middle of a crisis, it's always difficult to take a call. And once the crisis ends, the businesses will start to do better. And that's what people who are invested in equities believe at this point of time. And of course, on a like-to-like basis, there has been a fall in the market compared to where we were at the end of April, at the end of February. So to that extent, yes, the additional investments are also going in at lower levels, which of course would discount some of the damage that has been done to earnings trajectory because of the war. So all in all, I would say that anyways, in equities, you cannot predict the short-term return trajectory, or you should be looking at short-term in the first place. And if you are a long-term investor, if you are going to make staggered investments, I think the lower valuations that have been offered by the market is another good entry point to do that.
No, but the concern and question is where, because the nature of what we're seeing is so unprecedented, Harsha. There is a fear that some things may change in a more permanent or long-term fashion. In that context, what are the sectors that you see more likely to bounce back first or safer bets?
I don't think there is any safer bet in that sense at this point of time, except for maybe the defense segment, which will continue to receive orders despite what's happening around the world. That's the only segment where you can be very confident in terms of the demand continuing at the same pace or at higher pace. Most of the other sectors could get impacted if there is a prolonged war. It's all about not just about the price, right, Tamanna? Right now, the issue is more about the price rise and how it's going to impact margins and all of that. However, if there is a damage to oil infrastructure, which is going to lead to a medium to long-term impact on the overall production of oil and derivatives, then that's where the market would take it as a medium to long-term negative and start to price in. At this point of time, I would say that most of us are expecting it to be more of a short-term impact just on the pricing rather than on the availability. Yes, there are logistical issues, but it's hoped that those logistical issues will get resolved at some point of time in the future. However, if there is an impact on the infrastructure, then it would take time to rebuild those assets. And to that extent, then the earnings trajectory could have a meaningful damage depending on what happens, etc. So that's not something that we are pricing in at this point of time.
Speaking about pricing in, this is Alex, by the way, what do you think the market is currently pricing in, which is that you've seen a depressed market for quite a while now, and you've seen quite a crack, particularly over the last 1 year across the board. But what is the market pricing in on the earnings side, in your opinion? There is obviously a shock, but what is projected?
Alex, clearly, market was trying to price in a recovery in terms of earnings at the end of January or February. To that extent, that notion is somewhat getting tested at this point of time. I would say that the market is probably pricing in a similar kind of financial year as compared to financial year 26 now, as we speak. However, it all depends on the extent of war and the damage that it would leave on a medium to long term basis, right? Right now, when we are in the middle of the war, it's very difficult to really put a figure in terms of what's going to be the earnings number for the full year. It all depends on how long this continues, but it's fair to say that at least a couple of points of earnings will get shaven off because of the war. And if it extends, of course, there is going to be more damage to earnings.
The reason I was trying to get that is that I think a lot of people are building that consensus that now is a good time to start taking a greater exposure to equity, particularly because of the valuation argument, right? And so if we are pricing in a lower earnings situation and then there's a resolution over the next 3 to 4 weeks, say, then there could be a significant up move if those estimates are correct, or maybe even a little more pessimistic. That's what I was trying to get at, but I guess it's too early to say. How much, Harsha, of a bearing could monetary policy have? Because at this juncture, globally, you're seeing a situation where the markets are pricing in the possibility of interest rate hikes. In India, I'm not certain how much of interest rate hikes are going to be possible, because we're yet to see the price of fuel at the pump go up.
You're right, Alex. As far as India is concerned, the transmission of the high prices is going to take a little more longer time compared to global counterparts, I would say. And as you rightly mentioned, at least for now, we are not expecting any change in the interest rate regime. Of course, we cannot expect further cuts in interest rate, which was the case even earlier, I would say. We were expecting a longish pause in interest rate trajectory, and that's what seems to be continuing at this point of time. However, it all depends on what kind of retail petroleum prices would start to get priced in, and what will be the second order impact of that on other inflation, etc. But at this point of time, I think we are reasonably better placed compared to many of the global economies in terms of handling the inflation. So to that extent, I would say a pause is what one can expect from monetary policy, at least for now.
You're not factoring in a hike in order to stem any slide in the rupee or otherwise. You are baking in a pause for the rest of the year, Harsha.
That's right, Neeraj. At this point of time, it's more of a pause. However, we need to keep an eye on the war and what is likely to happen on the prices, etc. But for now, we believe that it's going to be a pause.
I hear you. Okay, Harsha, the other thing is I'm just trying to hypothesize that, assuming, let's hope for humanity's sake, the conflict ends in a hurry and there is a relief rally, whatever extent, 500,000, 1,500 points, whatever it is, and whatever number on the valuation it reaches. Will the markets have a different bounce and a different trajectory, unlike the previous crashes, simply because this time around, the supply side challenges will come to the fore, as you highlighted as well in your earlier answer, very, very swiftly. A lot of damaged infrastructure will not be turned around at a flip of a switch. It will take time. And therefore, there could be second order challenges which will come back, and the markets will start pricing them in once the initial bounce is over.
Neeraj, I mean, if we are pricing in kind of an early resolution, which means over the next week, 10 days, etc., then I think market will take it in the stride. Yes, there will be some minor impact to some oil infrastructure, but it's not going to really derail the overall oil market. Right. However, if this extends, or even if there is an early resolution, that resolution comes after some serious damage to oil infrastructure, then I think there is a problem. Right now, markets are kind of pricing in the logistical issues that most of us are experiencing in terms of availability of oil and a little bit of higher prices, which at the moment seems like it's more of a short-term blip rather than a structural change from a medium to long-term perspective. However, if that hypothesis changes, then of course you will have to redo your earnings expectations. You will have to reevaluate your valuation thesis. All of that will become necessary.
Okay. And Harsha, where do you how do I say? You could almost divide the market into cohorts, right? There are a set of stocks which have been impacted by the conflict, will probably continue to get impacted, but the valuations have certainly gotten decimated there. Is that the pool that you fish in, or you steer clear of anything that could presumably get impacted by the conflict and the after effects? Because there are enough and more sectors that have also seen a valuation reset because of just the broad nature of the downtick that we've seen in the markets. I mean, I'm just using that as an example so that viewers understand. But Airtel may not get substantially impacted because of the conflict, but even that has seen a valuation downtick. So is that the kind of pool of stocks that you fish in?
Neeraj, I think it's better to keep a diversified portfolio in focus. While there could be a very, very strong pullback in some of the segments where there has been a larger impact because of the war, for example, oil marketing companies, aviation stocks, or some of the chemical stocks, or some of the areas where fuel becomes a larger part of the overall margin profile, etc. There could be a sharp bounce back if there is an early resolution to the conflict, but we'll have to, again, as you rightly mentioned, we'll have to evaluate from a bottom-up basis whether those changes are sustainable or not, right? Then there is other basket, which is largely insulated from what's happening. However, because of the negativity in the market, those stocks have also seen correction in valuation. So there are two of these baskets. You need to be in both of those baskets. You can't be extremely focused on one because at this point of time, since it's an evolving situation, it carries more risk. So to that extent, as a portfolio manager, we would prefer to have a diversified focus on almost all of the sectors, and then take a call as situation unfolds. It'll be better to take those calls rather than preempting something at this point.
Harsha, thank you so much for joining us on the show. Always a pleasure to have you on. Harsha Upadhyay, there, CIO, Kotak Mahindra AMC. Speaking now with Amish Shah, Head of India Research at BofA Global Research. Amish, very good afternoon to you and great to speak with you. You know, when we were discussing your report this morning, things were looking much gloomier than they are now. But then again, that is the nature of the world that we currently live in. I just want to come to you on your Nifty outlook for 2026. And of course, it has been cut significantly and understandably. What do you think are the residual pain points India will see when this war situation eases? Because it will happen sooner or later. But what is the damage that has already been done to corporate earnings in India?
Absolutely. First of all, thank you, Tamanna. Always a pleasure talking to your team. So look, I think the damage is more in the on the front of macro and commodities. So even if the conflict were to end immediately, it will take some time for energy supplies to come back to normal. And as a result, we do think that the crude, which was at around $60 a barrel prior to the conflict, is likely to stay elevated for the rest of the year. We are working with a target of 92.5 for the year as a whole, which basically means $100 for the residual year. And as a result of that, and that aside, obviously there is impact from natural gas, LPG, all of these put together. We do think that the GDP growth, which we were estimating at 7.4% earlier, is now likely to be more like 6.5. Fiscal deficit, which was budgeted at 4.3, is likely to be 5. Inflation is going to go up. We are also talking about 50 basis points of interest rate hikes. So all in from a corporate earnings perspective, we do think that FY27 earnings could settle down at 8.5%, much lower than the consensus at 15 as of now.
So that's a sharp cut. But even for the Nifty target to go from 29,000 or to 26,200, are there some sectors or stocks that you think would be relatively unscathed, or less hit, Amish?
Absolutely, Tamanna. So there are some obvious sectors, like let's say the regulated power utilities. They are, as the word suggests, they are regulated and therefore they are on guaranteed profits. So conflict or no conflict, their profits does not get impacted at all. So those I think are definitely going to be outperforming. IT is another sector where we think that because of the conflict, rupee, as we know, has depreciated. And while on a long-term basis, we are not that optimistic on IT, but in the near term, clearly IT stands out as a sector that in fact benefits from a rupee appreciation. Pharma is the next one. And then we do think that, some of the capital market plays on increased volatility will see in fact increased business. So some of these we think are beneficiaries actually. And if you believe our view of rate hikes, then banks, SOE banks, some of these rate sensitives will actually see NIM expansion as a result of the rate hikes, so they will benefit as well.
Okay, very interesting. Amish, good afternoon. Alex here. So one line in the report was that markets are not yet at true value zone or in a true value zone. And from the layperson's perspective, they've looked at 2 years of relative underperformance and a crack, particularly over the last 1 month. But having said that, valuations haven't come off very dramatically. Of course, they've come off, but compared to average over the last many, many years, we're still above, aren't we?
Absolutely. So see, valuations you can cut in multiple ways. So you can look at valuations of Nifty compared to its own history. You can look at Nifty in comparison to emerging markets. You can look at equity valuations compared to bond markets, and so on and so forth, right? So as of now, when we look at the valuations as a totality, because of the conflict, while Indian markets sold off, so did some of the other emerging markets as well. So on a relative basis, India's valuation premium to emerging markets is still quite elevated. And as a result, India in the context of EMs is not still that attractive. Secondly, bond yields, as we know, has gone up from 6 to 7.1. And as a result, bonds versus equities, the equation is still not completely in favor of equities as of now. But Nifty, in comparison to own historical valuations, has obviously come off, and that is an encouraging sign. So that's why I would say that valuations have become reasonable, but valuations are not really in a deep value zone. So you will make money, but if you're a foreign investor, you would possibly make money in other emerging markets as well. So therefore, our view that India will underperform EMs, but from the current levels has a potential of giving you a 15% rupee returns. So I guess if you're a retail investor in India, you could play for that 15. But if you're a foreign investor, you are going to compare that 15 minus the rupee depreciation, and that in comparison to emerging markets like Korea, Taiwan, China, etc., where India does not stack that well.
That's a fair point. I do want to ask one last bit, which is, why is this different from a COVID-19, say, for example, or a certain other crisis that you might have seen between 2010 and 2020? We're actually seeing significant damage, Amish, being made to oil infrastructure. And so you can have perhaps a year, 2 years, 3 years, 4 years, maybe in certain situations where this infrastructure limps back. So therefore, is this going to be a protracted period of higher commodity prices and thereby scrimping of margins for corporate India, various other problems geopolitically leading into balance of payments problems for India? Is that why this is different?
Well, yes, Alex. The short answer is yes. While we agree that the damage to the energy infrastructure because of the conflict has been there, and commodity prices as a result will continue.
Hi, I'm Tamanna Inamdar. Watch me on NDTV Profit, where I break down the day's biggest business stories. What happened, why it matters, and what it means for your money.
Hi, I'm Neeraj Shah. Watch me on NDTV Profit for the most incisive market intelligence and meaningful corporate conversations.
And I'm Alex Matthew. Markets, mutual funds, insurance, personal finance. I help you cut through the noise and make smarter financial choices. And here's where you can watch us.
Presenting the all-knowing, all-powerful Tech Guru.
Whoa. Guru? I'm no guru.
Okay.
I'm just a guy who loves his tech.
A show where the mysteries of megabytes and motherboards shall be unraveled.
Bro, nobody talks like that anymore. This is all about connected ecosystems, EVs and AI that you can use in your daily life. That's what we do on Tech 360. Real talk, real reviews, tech that you can actually use.
Tech has changed. So should your tech show.
To understand the Tamil Nadu twist, join me in the midst of our people, language and politics. Vanakkam Tamil Nadu, here we come.
When others are warming up, I'm raring to go. The stories that matter, the stories that shape your life.
Hello and welcome to watching Prime 5 with me, Ganesha Ecosphere.
The show that sets the prime time agenda.
We'll be deep diving into this topic to tell you what's at stake.
Join me, Raisha Sehgal, on Prime 5 only on NDTV 24/7.
Sun win with a hand in hand? Will the two leaves and lotus bloom? Who will whistle to success in Tamil Nadu? To understand the Tamil Nadu twist, join me in the midst of our politics and people. Vanakkam Tamil Nadu, here we come.
Hi, I'm Tamanna Inamdar. What happened, why it matters, and what it means for your money.
Hi, I'm Neeraj Shah. Watch me on NDTV.
Good evening. Welcome to the big question on NDTV Profit. I'm Vikram Oza, and tonight we're looking at how wars and geopolitics are no longer just reshaping the oil markets or the trade routes, but the very plumbing of the internet where the world's data lives. So over the last month, conflict in West Asia has pushed these data centers into the line of fire. Iranian drones have struck multiple Amazon Web Services, AWS facilities. This has happened in Bahrain, it has happened in the UAE, and that has disrupted cloud services that are used by banks and hospitals and telecom companies as well. In fact, Oracle's Dubai office was hit by debris. And for the first time, global cloud infrastructure has been directly targeted in a war. So now tech firms are openly being declared legitimate targets. At the same time, of course, submarine fiber optic cables running through the Red Sea, as well as the Strait of Hormuz, which carry most internet traffic between Asia, Europe, and the Middle East, those are emerging as critical choke points. They're vulnerable to both conflict and sabotage. So all of this that we are talking about is forcing companies to fundamentally rethink how resilient their data infrastructure really is. Earlier, cloud architecture was built around nearshoring, which means keeping backup data at centers which are close to primary hubs for efficiency and for lower costs as well. But now what's happening because of the wars? The geopolitical risks are rising, and those are pushing these firms to move workloads much farther away into safer, into more stable geographies. So in effect, geopolitics is reshaping the physical architecture of the internet as we see it. So you're seeing the nearshoring model, you're seeing the offshoring model, and the differences are quite stark. This is where India enters the picture. When you're talking about offshoring and that model, over the past few weeks alone, India has seen this spike in data center capacity demand of nearly 200 to 500 megawatts. And industry estimates suggest that India could absorb up to 15 to 20% of the Gulf workloads in the near term itself. We have lower costs, there is growing capacity as well, there is strong domestic demand, and there is supportive government policy. So all of these are factors that help us. India is being seen as a serious alternative to traditional hubs like Singapore, many other parts of Europe as well. So we are getting that much more competitive. But of course, cost alone does not make a global data hub. The question is, do we have the power? Do we have the connectivity? Do we have the water, the regulation, the security? All of these are required and they're needed at scale. So are we ready for the next wave of AI-driven compute and GPU demand is the question. Are there strategic risks in becoming a critical node when it comes to global digital geopolitics? And that brings us to the big question that we're asking tonight. There you have it in front of you. Wars are forcing these data center relocations are taking place right now as we speak. So does that mean India has a great opportunity? Where do we stand when we are considering the rankings of countries that are becoming digital hubs? Is India in that top of the list to be able to become a digital hub for the world? That's the question we want to ask, and it is a big one to take across to our panel. Who's on our panel? Let me introduce you to them. Let's first begin by introducing our guest, Sunil Gupta, co-founder, managing director, chief executive officer of Yotta Data Services. They are cloud and data center infrastructure players. Sunil is joining us from Mumbai. Good to have you with us. Also with us is Sharad Agarwal, who is chief executive officer of CIFI Infinite Spaces Limited, I understand. He brings deep operational insight from the data center business again. He's joining us from Mumbai. And adding that policy and geopolitical lens to the discussion is Sumesh Srivastav. He's partner at the Quantum Hub. He joins us from Delhi. He closely tracks tech policy and digital sovereignty, global governance trends. And rounding off this panel is Dr. Arvind Gupta, head of the Digital India Foundation. He joins us from Mumbai. He's got this vantage point on India's digital public infrastructure, regulation, the long-term strategic positioning, as it were. So thank you, gentlemen, for making the time for the big question. Sunil Gupta, for the first time, we are seeing hyperscale cloud infrastructure directly hit by the drones. So we're talking about these AWS facilities in Bahrain and the UAE getting disrupted. So customers have been advised to migrate out. But if you look at it from an operator's lens, is geopolitics really now actively reshaping the geography of the internet itself? How do you see it?
Thanks, Vikram, for having me here. I think fundamentally, let's understand data centers are very unlike commercial offices or residences. You can plan commercial offices to be shifted out and then again you shift back in when the situation becomes normal. But data centers are planned for 25 years, 50 years. Because once you have got your critical business applications running in, you have got hundreds and thousands of network links terminating there, it becomes extremely, extremely difficult to move them out. So if an area becomes geopolitically unstable or risky, companies which are hosting their critical applications there will become very wary, and they would like to shift as soon as possible into stable locations. While the traditional factors for deciding data center location has been whether you've got enough land, whether you've got enough power, whether you've got enough fiber, whether the latency to your target users is good or not, and of course, the cost of building it and skill sets and everything else. But on the top of that, let's understand data centers are running critical business applications. So, and they are supposed to be available 100%. So the topmost criteria in the current geopolitical situation becomes that are you into a location which is safe from such risk? Yeah. Considering that with India, I would say having all the ticks or right ticks in the boxes, whether it is Having built a huge data center ecosystem already for the last couple of years, enough of land, enough of power, a huge part of that power being green power, top quality data centers being built over the last 7-10 years, all the hyperscaler already being here. Even if we keep on building for next 7, 8, 10 years, even if we multiply 7 or 8 times, we still don't go into the risky zone of that. So much of power is being used as a percentage of the total power of the country.
Correct.
I think India has the capacity to absorb.
You think India has the capacity? And Dr. Arvind Gupta, I want to take that across to him. Do you think India has that competitive streak when data centers and subsea cables, even AI infrastructure, all of these are becoming military targets? Are we now entering this new phase of digital geopolitics where data infrastructure is becoming as strategic as the oil pipelines, as the shipping routes? And how does India fit in over there?
Well, Vikram, let me first start off by addressing you and your audience. We always use the word data is the new oil. So, of course, data and data centers are a very strategic asset for any nation, any society, any business right now, as much as any oil pipeline would be. Because as Sunil Gupta said, we have to understand a couple of points, and I'll answer your question, but please, and I'm happy to give time to others later on. There are data centers today, the cloud centers, the hyperscalers are running both national security applications, intelligence applications. They are also running a lot of critical business applications, as Sunil said. And this is very critical. It's an economic factor of production. So when you have this, so they do become part of the geopolitical game. They become a target. And that is, as much as you said, you're crippling the oil pipeline or any other supply chain, this is now an integral part of the economic growth of any society. So by attacking those, you're attacking the economic might of that region.
Absolutely.
Number one. Two, the data centers or the hyperscale infrastructure used to have seismic, redundancies, used to have in 2 seismic zones, used to be away from tsunami zones. There were so many other considerations. Now, of course, the consideration is geopolitical stability.
Yes.
Cost is not going to be a factor. You keep using this word nearshoring and all. Now it's going to be friendshoring. And let's be very clear on this. It's going to be friendshoring. It's not a cost factor at all.
Mm-hmm.
You have seen this in Ukraine. You have seen this in this whole Middle East crisis. Businesses have moved away from just because it was low cost.
Right.
It's not going to be a factor.
Right.
It has to be a geopolitical decision.
Yes.
It has to be a strategic decision. It has to be.
Let me ask Sharad
region
Agarwal.
Where you're friend.
Yes.
Let me just make one final point, and that's a very important thing before I give it to Sharad, and then you can take it from there. India has not only just the hardware, the talent. We always had it, but now the policy infrastructure. Even before this conflict started, there was a tax holiday given to data centers till 2047.
Yes.
To build data centers in India. So that's been the foresight of this government.
Correct.
That we will be the second, if not the biggest, but at least the second biggest data center capital of destination.
So there is political will, is what you're saying. Sharad Agarwal, about this point about friendshoring as opposed to nearshoring, that model that is now pushing companies to move workloads thousands of kilometers away. Do you agree that that's how it is being done? And if that is about friendshoring, then how does India add up in that entire global picture?
See, the kind of workload that we need to see that there is growing in the industry is the 2 or 3 types. One is the AI workloads that require training. Then the workload comes once the training is done, then the inferencing. There are certain these kind of workloads that basically do not need to be very close to the user base. They have to be where it can be properly accessed, properly processed, and properly trained, and then given out as an outcome, as an intelligence. So therefore, there is a huge amount of, you could say, the opportunities or the workloads that do not necessarily need to be near shore, on the shore. It has to be a place where data can be considered safe.
where it can be processed in the manner that it can produce the outcomes and the intelligence that is required and be used for the purpose of the use cases or the inferencing that is the need. So yes, friendshoring is really the right one.
Right.
Dr. Gupta has really taken the right term there.
The right term.
That it is, and then exactly the same thing what Sunil was also saying. The important is the safety of the data, security of the data. Because over the time, this data is likely to be used as an intelligence, and you need to know that everyone needs to know that this intel can be then misused if the data was not used properly or safely. So yes, I agree with that.
Right. So in fact, let me just take that across before I go across to Sumesh, to Sunil Gupta. We're talking about safety. How safe an environment is India offering? We're hearing that just in the last 3 to 4 weeks, India has seen a spike of 200 to 500 megawatts of demand. So one wonders if this is purely a war-driven panic response, or it signals a permanent shift towards, geographically distributed cloud architecture, and the safety aspect of what India offers right now is quite strong.
Vikram, I think if we just go a little back in history, from 2000 to 2015, we as an industry we built around 200 megawatt of data centers, because the driving factor was more of an enterprise workload getting into third-party data centers. But the moment global hyperscalers decided to come and many other tailwinds, including e-commerce, 4G, 5G, fiberization, everything happened. Cloud operators came to India, and that 200 megawatt of 2015 has already become about 1.5 gigawatt of today, which is 7 times. The last 7 or 8 years, India has built, commissioned, and delivered to customers almost 7 times the capacity. And even without AI coming in, or this Middle East problem coming in, this 1.5 gigawatt would have become 3 gigawatt easily by 2030, based on the announced projects of various operators and announced offtake by various hyperscalers and enterprise and government customers. So this build out was already happening. Even before Middle East crisis, because AI came in, we all as the industry were very, very, I would say, unanimous that this 3 gigawatt now is projected to become 6 gigawatt or 7 gigawatt or 8 gigawatt.
Right.
So a natural organic growth because of the regular applications, and inorganic growth because of AI coming in, taking Indian market to 7-8 gigawatt was already there, which itself is very, very high compared to today's 1.5 gigawatt base.
Right.
Now, what I'm taking about is that this Middle East crisis is adding on the top of that. Maybe a 7 gigawatt may become 7.5 gigawatt. So it is not something which suddenly is coming as a very big opportunity as well as a big problem to handle. It is like the growth of India in any case was happening because of various factors. This Middle East factor is going to add to that growth. So if we were planning for maybe a 300% growth, it may become a 350% growth, but that is what it is.
So like you're saying, I mean, this is an opportunity for India. It is adding towards what we were already building by way of capacity. Sumesh Srivastav, historically, cloud investments, they followed cost, but now with disruptions like the kind that we're talking about, the AWS Bahrain, the Red Sea cable risk, we've talked about that on the show as well, the cyber attacks like the Iran-linked Striker hack. Are these global cloud giants explicitly prioritizing security and political stability over pure economics? And in your understanding, where does India stand on that count? Sumesh, you need to unmute yourself so we can all hear you.
Sorry, I'm really sorry for that. Thanks for the question. So yeah, I would agree with you on this partially, but I would say that when we're talking about cost here, from my perspective, what has changed now is the definition of cost, right? Earlier, so cost now includes the cost of disruption as well. So if a region can offer cheaper power and land, but carries a meaningful risk of your facility being physically damaged or attacked or rendered inoperable by conflict, then the total cost of operating there goes up significantly once you factor in things like insurance, redundancy, and potential downtime. So I would say the selection criteria has expanded. While 5 years back, you might be optimizing primarily for power cost, land availability, and things like this. Now, geopolitical risk, physical security also sit along these factors. I would say India benefits a bit from this expanded criteria because we have had a history of a non-aligned foreign policy. We do reasonably well across most of these dimensions. And one of the concepts that I wanted to sort of discuss here is the idea of data embassies, right? It's a idea which was pioneered by Estonia, but the idea is that a country can store its sovereign data on servers in a foreign jurisdiction while retaining full legal control and diplomatic immunity. So in India, we've seen in a couple of years back in the budget that was announced, the gift city is something which is being positioned as something like that.
Okay.
So if this develops further, it will add a new dimension to India's cloud infrastructure.
So are you saying, Sumesh, that India is being seen as a backup geography or as a serious primary AI infrastructure destination right now?
So I would actually push back on that backup framing, because I do agree with Sunil sir in terms of India was already on that journey, right?
Okay.
Like we have so many driving factors. We have the DPDP, we have a huge scale population.
True.
What this will do is this will accelerate that transition.
Correct. Fair enough.
Yes.
Sharad Agarwal, now that India offers nearly double the data center capacity for the same investment compared to what Singapore did or parts of Europe did, but now is cost going to be enough or not is the question. You said that India offers a lot more. What are the non-negotiables where India is still falling short today that we need to cover ground on to seize the opportunity?
India has taken all the opportunities. There is nothing on short as far as I am seeing. We have enough talent. As we have the panel already spoken about, that we have enough infrastructure available, power is available, and enough, you can say all kinds of intent is available, and the capital is also there. So I won't say that there is any kind of a falling short anywhere. It's just about ability to execute. It's just about how much capacity we can build to solve and to serve this demand that is coming from the AI side.
Right.
And be able to ensure that we are able to do it faster and faster.
Faster and faster is the need. Right. I mean, yes, sir, to be able to build that ability, where do we stand right now?
So far, India has just 1.5 gigawatt of the operational capacity, which is not even 5% of what the United States have. And the need for it, as you have seen in the, have shown in the screen before, is more than 10 gigawatt of capacity. So how fast we can build this is the most important part.
So I was looking at a Morgan Stanley estimate, Sunil Gupta, where India's data center capacity could jump from 1.8 gigawatts today to over 10 gigawatts by 2030. So on the ground, do you realistically have seen the availability of power, the availability of water, the grid stability as well, which is required, and land? The availability of land is also important to support this kind of scale that we are talking about.
Quickly to give you some numbers, because there are certain perceptions which stay with India as much as you try to remove that. Today, even with 1.5 gigawatt of data center capacity, we are just 0.4% of the India's total power generation, which is around 550 gigawatt, right?
Yes.
Even if India scales to 10 gigawatt of data center capacity, let's say by 2032, by that time, even India's power generation capacity will become around 800 gigawatt. So again, it will be less than maybe 1% or 1.2% of the total power generation capacity of country. And the good part in India, thanks to its location near equator in a tropical area, we are also blessed with so much of sun and so much of wind that our green index in the total power also is more than 52%. So from power point of view, we have challenges in terms of last mile. You build data center outside a city, your power infrastructure may not be there. So how do you build substations? How you take the last mile cable connectivity either overhead or underground? That is the thing you have to take care. But let's understand.
Correct.
If we have been able to take 200 megawatt to 1.5 gigawatt in 7 years, and we all have built data centers in less than 18 months while the world takes 4 years, it means India and India have capability to build world-class data centers serving hyperscalers. We all jointly are building data centers which can handle GPUs, liquid cooling. I don't think there's the issue of power. There's not an issue of...
but last mile connectivity is an important piece, right? Sharad Agarwal, data centers, they already consume about 0.5% of electricity, and this is projected to double by 2030. I'm wondering whether the state governments, whether the discoms, they are ready for hyperscale AI-led loads.
This is where the collaboration come into the picture, where the discom, the transmission company, the generation company, and the data center industry come together to project and clearly forecast what is our consumption, where it will be, and to what extent it will be. Sunil and I and all of us in the industry sit together in the different industry bodies and work together with these the utilities to make sure that we have these capacities available at the right place at the right time.
Sure.
And also Vikram, I want to add one point and that I want to clarify here. We don't use water. So this water bullet is not the right bullet.
Okay.
India has long back taken the responsible call to not or minimize the usage of water in the data center. So we will not be using water, and the water is not an impact. There is no impact to the water usage or the water
Fair
needs.
Point.
And there we can probably should have a separate discussion and separate dedicated panel on this one so that we could remove that notion altogether for once and all.
No, fair enough. But Sumesh, just wanted to quickly come to you before I go across to Dr. Gupta as well. You know, the US, they have successfully allowed NVIDIA's advanced chips to flow to the UAE and to Saudi Arabia. So does India risk falling behind if chip access, not just data centers, chip access becomes the new geopolitical choke point, as it were?
Yeah, so actually, like for India's story, that's actually the biggest risk factor, right? Like for us, the gap is on the hardware supply chain side.
Right.
So every GPU in India's AI compute fleet is imported. The semiconductor mission 2.0 is focused on chip design and IP development, but which is the right long-term strategy. I agree with that. But it does not address the immediate import dependency, right? So if global semiconductor trade dynamics shift, whether through export controls or tariffs, as we've seen, or supply disruptions, so our ability to scale, irrespective of everything else being in our favor, is constrained by factors entirely outside of our control.
Sure.
So it requires not just deploying GPUs, but also building resilience into how you source those GPUs.
Dr. Arvind Gupta, what do you say about this? Also, as foreign hyperscalers, they expand rapidly in India, I'm wondering if there are new vulnerabilities that we risk right now. Surveillance concerns, data sovereignty challenges, over-dependence on global tech giants. What do you see as the risks?
There's going to be a mix and match. Let me first give you three responses very quick, short of time. Number one, there's going to be operational innovation. India has already shown that. And so don't think that whatever works everywhere else will work in India. We'll innovate operationally. There will be energy innovation. There's a lot of local innovation happening around, the whole deployment of data centers. Two is that there is $250 billion already committed post the AI summit. And see who has committed that. Adani is the L&T. These are infrastructure companies. So there is the intent is to build infrastructure at very fast pace and build it at scale. So be rest assured that once these kind of companies come into the fray, there'll be fast rollout. Three, the GPU question is a valid question, but you have to understand it's a bottom-up pressure. The companies which were operating in Middle East and they had this GPU availability will be now asking their government back in the US to make the same GPUs available.
Yeah.
I know Sunil Gupta's company has a very good tie-up with NVIDIA and others will also. So I think there is a problem, there is a dependency, but it is something that works in everybody's favor, and which is the path that India has shown to the world that that working with India is going to be to the benefit of the big tech and to the local providers equally.
So
lastly, to answer your question on data sovereignty and I think you have to give the benefit of intelligence to the government of India. We understand what to be stored in IOTA, where to be air gap our data, secure data, and what not to be stored in AWS or a Google Cloud. I think I'm not going to comment more on that, but you undermine the understanding and of the technology capability of the thinking of this government. Let me assure you, we know what to put where.
So talking about what the government is doing, Sharad Agarwal, very quickly, because I have to wind this up, the budget offering tax holidays for data centers until 2047, a big push to deep tech and AI. Is that going to be enough, or does India still need a clear national strategy on becoming a global data hub? Should India explicitly position itself as the data center hub for West Asia and Asia, or could that pull us deeper into global conflicts that we are trying to stay neutral in?
No, this is a good initiative, actually. This has removed a great amount of risk that the global organizations were seeing while bringing the data into India and being risked from some of the Indian tax provisions. So this is definitely a good provision, but it's a work in progress.
Right.
It's what we need to do as a country to attract more and more. It's a work in progress, and I'm sure we will keep coming up with more and more initiatives around that. I would say that way. But the most important part is ease of doing business improvements, so that we could do a real single window clearance and be able to get to the floor faster, get to that, reduce the time to market as much as possible.
Yeah.
We execute and take this opportunity to execute new capacities in less than 18 months, so that we are able to react to some of these evolving situations faster and faster. So all of initiatives and the policies has to be addressed towards that.
So clearly wars are no longer just redrawing borders. They're redrawing the digital map of the world. So data centers, the cables, AI compute, they've quietly become strategic assets. And India right now, from everything I'm hearing, it finds itself at a crossroads where opportunity and responsibility arrive together. I want to carry on this conversation, but of course we'll circle back. But thank you to my panelists, Sunil Gupta, Sharad Agarwal, Sumesh Srivastav, Dr. Arvind Gupta. Such a pleasure having you, bringing clarity, depth, and these perspectives on a very critical conversation. And to you, our viewers, it is an important big question that we're asking, because as far as opportunities are concerned, as far as the wars are concerned, as difficult and as traumatic as they may be, there is an opportunity that India is quietly building on. Can we just become hosts to the world's data, or can we now redefine the global digital order, as it were? That's an important question I'm leaving you with. I'm Vikram Oza from me and the team on The Big Question. Thank you for joining us. Good evening.
Hi, I'm Tamanna Inamdar. Watch me on NDTV Profit, where I break down the day's biggest business stories. What happened, why it matters, and what it means for your money.
Hi, I'm Neeraj Shah. Watch me on NDTV Profit for the most incisive market intelligence and meaningful corporate conversations.
And I'm Alex Matthew. Markets, mutual funds, insurance, personal finance. I help you cut through the noise and make smarter financial choices.
And here's where you can watch us.
Presenting the all-knowing, all-powerful Tech Guru.
Whoa. Guru? I'm no guru.
Okay.
I'm just a guy who loves his tech.
A show where the mysteries of megabytes and motherboards shall be unraveled.
Bro, nobody talks like that anymore. This is all about connected ecosystems, EVs, and AI that you can use in your daily life. That's what we do on Tech 360. Real talk, real reviews, tech that you can actually use.
Hello and welcome viewers, you're watching Market Express and I'm Himakshi Bahugna. Let's get straight into the show and see how the markets have really fared today. So markets have reversed the early losses to end the day near day's high. Both the Nifty and Sensex have ended 1% higher. Trent and Axis Bank have lent support and also surges in trade on the back of strong Q4 business updates. Now RIL ends as one of the top Nifty 50 losers. And talking about the sectors, so most of the sectors have ended the day in green, with PSU Banks Realty leading the gains. And oil and gas on the flip side held on to a tinge of red. Now let's look at some key stocks that were buzzing away in trade today. First up, we have Trent that has wrapped up the March quarter with a solid, showing, delivering a 20% revenue growth, which is an improvement over the previous 2 quarters. And also the store expansion continues at a healthy pace, and this has been led by aggressive additions in the Zudio and also steady scaling at Westside as well. So while the average revenue per square foot has softened slightly, management remains confident about the company, also maintaining 20 to 25% of growth guidance as demand traction is expected to improve over the medium term. And with also valuations now below historical averages, the spotlight shifts to execution, store productivity, and also earnings delivery in the coming quarters. And here's Nykaa has delivered yet another standout quarter, marking its strongest growth in the last 12 quarters. So the momentum has remained broad-based with, consolidated GMV growth tracking in the late 20s, while the net sales also, value growth that ran even stronger for the company. And the beauty business, if we look at, has continued to fire on all the cylinders, supported by the company's highest ever quarterly store additions, while fashion has seen accelerating revenue traction with the NSV growth clearly outpacing the GMV. And importantly, management has flagged no impact from the Middle East exposure so far, keeping the near-term risks contained as Nykaa sustained its growth trajectory. And next counter in focus is Wipro that has landed a rare big ticket win. Now the IT major has secured $1 billion transformation mandate from the Olim Group, which is spread over 8 years and also offering long-term revenue visibility at a time when large deals are hard to come by. And the engagement will be delivered through a consulting-led AI-powered approach, also signaling Wipro's push towards higher value transformation work. Crucially, the deal also includes the acquisition of Olam's IT arm, Mindsprint, giving Wipro a deeper domain expertise in the food and also agribusiness space. So along with an embedded client platform as well. Next counter in focus is Pace Digitech, which is seeing strong order momentum pick up pace. So the company has received a large letter of acceptance from NTPC for a battery energy storage system at the Nabi Nagar power station, also reinforcing its positioning in the fast-growing energy storage space. So this adds to a string of recent wins across railways and also grid-scale storage projects. And this is also pushing the order book to over 8,000 crore rupees, with visibility improving and also a clear push towards clean energy infrastructure. Pace Digitech is now eyeing a further scale-up in orders by the end of this financial year. And viewers, next counter in focus is Vikran Engineering, which has received a fresh order boost from the Maharashtra government, also securing 2 projects worth over 530 crores across the Nashik and Kolhapur zones. The projects are spread across multiple locations and also are expected to be executed over the next 21 months. So the twin wins enhance the revenue visibility and also reinforce Vikran's presence in the state. So level infrastructure execution with a healthy project pipeline and also steady inflows. Focus now shifts to timely execution and also margin discipline as the company works through its expanding order book. Next counter in focus is Tata Motors passenger vehicle. So its passenger vehicle business is back in focus after a weak operational update from the JLR and also mixed volume trends in the March quarter. While the wholesale volumes have rebounded sharply after the cybersecurity disruption, retail sales continue to see year-on-year growth, degrowth, and also pointing to demand pressure. So geographically, if we look at, volumes remain lower across the most of the markets, with Europe, which is a lone bright spot there. Looking ahead, FY26 volumes are expected to stay under pressure, and this is weighed down by the US tariff impacts and also challenges in the China market. The planned wind down of the legacy Jaguar models ahead of the new launch and also production stoppages linked to the cyber incident. And if we also look at the execution and recovery, so that will also remain key themes going forward. And viewers, TVS Motor is firmly in focus after Goldman Sachs has upgraded the stock to buy, citing improving fundamentals and also stronger earnings visibility. Now, the brokerage has raised its target price, pointing to TVS's pricing power and also better ability to absorb the raw material inflation as compared with peers. So, Goldman has also highlighted superior volume visibility, and this is driven by upcoming premium launches, and also expects TVS to pass through the cost pressures more effectively. And adding to that, a margin tailwind from the PLI scheme, and also the brokerage is seeing TVS better positioned to navigate the commodity volatility and also sustain the profitability. Viewers, Nuvama Institutional Equities has also maintained its buy rating on Sobha even as it cuts the target price, and also citing a more cautious near-term macro backdrop. Now, the brokerage highlights healthy pre-sales and also a sharp surge in launches in Q4 of FY26, with Bengaluru expected to continue driving volume growth. However, Nuvama has flagged rising risk perception for the real estate sector, and this is also pointing to concerns around the potential job losses from AI disruption, along with uncertainty linked to the ongoing global conflict, which has weighed on the housing demand across markets. Now, the call reflects confidence in execution, and this has been tempered by the macro risks. Next counter in focus is Aurobindo Pharma. It has announced an 800 crore shares buyback and also signaling a return of capital to shareholders. So the company will buy back shares of 1,475 rupees a piece through tender offer route, with program open to all the shareholders, including the promoters. Now, the buyback involves just over 54 lakh shares, also representing less than 1% of the total equity, with the record date fixed for April 17, 2026. Now, from a balance sheet perspective, the buyback amounts to around 3.9% of the standalone net worth and also about 2.6% of the consolidated net worth. Now, keeping the financial impact manageable while also enhancing the shareholder returns. And PVC players are back in focus after a sharp price cut of around 10 per kilo, raising concerns over demand and also profitability. Now, Nuvama has flagged that this move as a potential trend reversal, pointing to weak agri demand and also heavy channel inventory, and also rising pressure from cheaper Chinese imports. Now, the brokerage has also seen April demand remaining soft, which could weigh on the volumes and also margins in the near term, with price-led volume recovery coming at the cost of realizations. Q1 of FY27 risks are building, especially for players like Astral and Supreme Industries, where EBIT sensitivity to PVC pricing remains very high. And viewers, Senco Gold has posted strong growth in the March quarter, riding higher gold prices and also steady wedding demand. So revenue has risen sharply, and this has been helped by solid same-store growth, even as volumes stay muted due to elevated gold prices, and the company expands its showroom network, protects the margins through tight inventory control, and also leans into affordable lightweight jewelry. Now, looking ahead, Senco targets healthy value growth, stable margins, and also a strong store expansion pipeline in the new financial year. Next counter in focus is Reliance Industries. It has come under sharp pressure, slipping to a 10-month low as selling intensifies on the street. Now, the stock weighs on the benchmark, with concerns rising around the impact of the US-Iran war on its energy business. Now, higher freight and insurance cost, muted growth in telecom, and weak gas output add to the drag, even as retail offers some sort of support. Now, markets now watch how the conglomerate, really navigates this volatility across its key segments. And here's beverage prices could be headed higher as cost pressures intensify across the industry. Companies like United Spirits, United Breweries, Radico Khaitan, Allied Blenders, and also Varun Beverages are facing sharp increases in packaging and logistic costs. So while alcohol makers need state approvals to raise the prices, non-alcoholic players have more flexibility to really pass on the costs. And NMDC hikes iron ore prices again, marking its third increase this year. This move is driven by higher global prices amid Middle East tensions, which is firm domestic steel demand and also strong restocking by mills. Now, the price hike is expected to support the NMDC's margins, with the miner already reporting strong production and also sales momentum. Now, markets are now watching how steel makers really absorb the higher input costs. And now let's look at some brokerage notes. Morgan Stanley says that seaborne iron ore prices stay elevated for now, but warns that higher shipments and also China's steel supply reforms could really turn the sentiment, negative ahead. And also the brokerage has flagged near-term pressure for the steel makers like JSW Steel and also JSPL due to their external iron ore dependence. And because auto dealers strike a cautiously positive note even as near-term risks remain in focus. FADA has said that March sales stay strong across segments held by healthy demand and also improved availability. Looking ahead, dealers expect growth to continue over the next few months, though concerns around West Asia led supply disruptions, fuel prices and also seasonal slowdown do persist, and the industry remains optimistic on the full year outlook while keeping a close watch on the emerging headwinds as well. And the government is considering shelving the current bids for the privatization of the IDBI Bank and also may call for fresh bids due to low valuations received. So a high-level meeting chaired by the Cabinet Secretary is underway to decide the next course of action. And this is the second such meeting in a week involving senior officials from DIPAM and also, the Department of Financial Services. Now, the existing bids are reported to be well below the government's minimum reserve price, with two potential bidders quoting valuations in the range of 40,000 to 45,000 crores. And also restarting the process with fresh bidding would take additional time, as it would begin, from the scratch. So a final decision is expected soon after the ongoing deliberations. And as Amul has become the first Indian FMCG company to cross 1 lakh crores in annual turnover. Yes, so the Gujarat Cooperative Milk Marketing Federation, which markets the Amul brand, has achieved this milestone in the financial year 2025-26. Now, this makes Amul the largest Indian FMCG company by turnover, surpassing many established multinational and also domestic players. Now, the achievement is driven by strong growth in dairy products, ice cream, and also value-added items across both domestic and international markets. And the Supreme Court has refused to stay the takeover of Jaiprakash Associates Limited by the Adani Group, and the court has asked Vedanta, which had challenged the resolution plan, to contest the matter before the National Company Law Appellate Tribunal, that is the NCLAT, and a bench declined to intervene at this stage and also said that the issues raised by Vedanta should be decided by the NCLAT, and this paves the way for the Adani Group to proceed with the acquisition of the debt-ridden infrastructure company. And the development is a major setback for Vedanta, which had approached the Apex Court seeking an interim stay on the approval granted by the NCLT. Next counter in focus is Nykaa, which is an advanced talk to acquire a majority stake in 82E, the skincare brand co-founded by actress Deepika Padukone. Now, the deal, if finalized, would mark Nykaa's entry into the fast-growing prestige beauty segment and also give its, control over one of the most prominent Indian celebrity-backed brands. So 82E, which focuses on clean and also science-based, skincare, has seen some strong growth since its launch, but has reportedly been, struggling with scaling and profitability. So for Nykaa, the acquisition would help expand its own brands portfolio and also strengthen its position in the premium skincare category. And Saudi Arabia has raised the price of its flagship crude sold to Asia to a record premium as the near closure of the Strait of Hormuz continues to disrupt the regional energy flows. Now, state oil giant Saudi Aramco has lifted the Arab Light prices for May sales to their highest ever level, and this is reflecting acute supply stress across the Persian Gulf. Now, the move comes even as the hike fell short of market expectations, also underlining extreme volatility as the Iran conflict drags on, with the Hormuz largely shut and also global fuel prices surging. The energy, shock is rippling across the markets, also pushing the crude sharply higher and intensifying inflationary pressures worldwide. And whereas OpenAI is facing internal differences over the timing of its much-awaited initial public offering, now CEO Sam Altman is pushing for an early listing, also possibly as soon as late 2026.